We are not forecasting a deep and very long recession, but let's not be too optimistic.
This year has been historically difficult, to state the obvious.
I think central banks really need to be careful here.
There's room, I think, for the Fed to step down.
If you look what the bond market's telling you, it's telling you the Fed is going to win the battle against inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We welcome all of you on a Thursday. Claims at 8:30, but far more of that. Getting to the holiday season, the oddity of a weekend, Christmas Eve, Christmas Day, it's a different season. I mean, starting with Hanukkah, Lisa, it's just a whole different feeling across America.
It's supposed to be over. The longest year in the history of the world is supposed to be over, one that has been incredibly tumultuous, and yet we've gotten a number of really big announcements that haven't necessarily phased markets as much as I would expect, and that, to me, is the year-end mystery. Is this just that people are asleep and away, or is this something bigger that means that perhaps the tail risks are changing next
I'm
year?
a big believer in the year-end lift, and we certainly saw that yesterday. We're going to look at economics, finance, investment today, some Bitcoin talk as well off of Mr. Bankman-Fried coming back from Bahamas, and of course, all that Anne-Marie Horton witnessed yesterday in Washington. But it's tough to stay focused, and to me, not the guilt of it, not to sound like I am, but there's a part of America celebrating a buoyant economy, participating in the economy, and there's another part that's just not in the script, and that's seen in the economic data.
Yeah, and cutting back, although the sentiment data, did you see the sentiment data yesterday that came out much better than expected? A huge upside surprise. How much is this being driven by the fact that gasoline prices are the lowest in the U.S. going back to July of last year? How much of this is actually true momentum? The bigger story to me, and I'm going to kind of rip up the script, but to me, the biggest story of the moment really is China's massive U-turn that has gone undiscussed in terms of the ramifications. The fact that suddenly they are open, full force, despite all the hospitalizations. Now this morning, did you see the announcement? They're not going to have to force foreigners to quarantine.
And you know, I read it with family in China, and what's so important here, folks, and this is Bloomberg reporting this morning, and Bloomberg reports that there's quarantine adjustments in China. We thank our Pacific Rim team for that. To me, it's a little bit of gobbledygook. It's like 8 days down to Q+3 and all that. I don't pretend to be expert on it, but this is a daily unfold, as you say, as we stagger to 2023.
Gobbledygook, yes, in the sense that it's hard to understand exactly what's going on, except the economy is suddenly much more in the forefront, and suddenly the Band-Aid has just been lifted off. I mean, it's been ripped off. All of a sudden, just out of the blue, there is no more COVID-0. It seems like the public testing, et cetera. The implications of that, people had been saying were vast, and yet we're not necessarily seeing them in market action.
We've got an important guest to start off with. We've got really interesting, really quality guest set for you today through the 10 o'clock hour. Lisa will be in for John 9. Ferro, where's Ferro? I mean, we believe he's like leaving on a jet plane
he's
back to the mother country.
He's actually celebrating his Christmas tree because it is beautiful and well adorned, and it has been for a
and
long time.
They could leave it up while he was gone across the Atlantic because I don't think it needs to be watered. I mean, I'm taking
really?
a reach there.
You're going to throw shade at his
I'm throwing massive shade at it.
Really? I think that there is something to be said for not having shedding pine leaves.
Actually, we should get Steve and the team out, and they can film me watering the tree at 3 p.m. every day.
You're
if
so resentful.
You want some comedy action.
You're resentful about this tree. Come on.
The tree, the squirrel comes down and sits on my head while I'm watering the tree. I want to do a data check here before we get to Jens Nordvig, and Lisa, help me out here. I'm going to look at the one single statistic I care about, and this is also the one that Chairman Powell cares about, and that is any form of financial conditions index. We use the Bloomberg Financial Conditions Index is a stunning negative 0.444. That index in its summation, including a buoyant stock market, Lisa, moves in an accommodative way.
And it has been pretty steadily with this lift in that we've seen heading into year end. What I find most interesting is the stasis that we're seeing in the dollar-yen cross, this question of what have the ramifications been of the Bank of Japan's move. We saw a little bit of a rebound yesterday after the biggest decline in the dollar versus the yen going back to 1998. We're just kind of hanging in there, waiting for the next shoe to drop. I want to just give you a sense. There isn't that much going on, but 8:30 a.m. we do get initial jobless claims in the third reading of the third quarter GDP read in the United States. At 11 a.m. we get Kansas City Fed's manufacturing index for December. How much does that slow down? This follows on what we heard from Micron yesterday in terms of demand not picking back up in order for them to become profitable. And I do have to say, you know, we're on weather watch, and that's what I'm watching is the bomb cyclone that people are looking at, and all of the. Well, it's actually a technical term. I did a lot of research on bomb cyclones, partly because I'm going to be among those trying to travel, and I expect to be delayed and marooned in airports and possibly.
Isn't a bomb cyclone called February in Detroit? I mean,
it's actually.
What is a bomb cyclone?
It's when the weather changes very quickly and very intensely, and that's what people are talking about. And basically, you're talking about sudden shifts in temperature that's 50 or 60 degrees in terms of a delta, and you're talking about snow and winds that rival Category 1 hurricanes.
We sit on a lawn in August at Jackson Hole. It's really beautiful, and it's usually very cold, like 45 degrees, and it's not funny. This morning on that lawn, it is minus 26.
See?
It is minus 26 in Wyoming at some point this morning. Be careful out there, and I know in New York City it's very cold come Saturday as well. Jens Nordvig won't be steeled from the cold. He's lived it in Denmark, and Mr. Nordvig joins us from Exante Data with wonderful knowledge, particularly of the transatlantic dynamic. Well, this is a question John Ferro had asked Jens. What is the European UK, U.S. dynamic next year? How will that play out in the litmus paper of the foreign exchange system?
Well, so we've had a situation where we had an energy crisis in Europe. The euro was under very significant pressure. People doubted that the ECB was going to really lift interest rates almost at all, right? And now we actually have a situation where the energy crisis is still there, but the tail risk is being removed. Prices are coming down. And the ECB is actually sending more hawkish signals than the Fed. Like ECB is saying we're going to go 50 basis points for a long period of time into 2023, whereas the Fed is kind of signaling that they may want to slow down, right? So things have changed very dramatically over the last 2-3 months.
Well, let's go to your book, The Fall of the Euro, which changed the dialogue 10 years ago, I'm going to say, Jens. And I don't need to know the gloom of the fall of the euro. I'll leave that to Lisa. But what I do want to know is, does Christine Lagarde have a nominal GDP spirit like Chairman Powell has in the U.S.? I don't observe it.
So I think Christine Lagarde's problem is that she's trying to convey a governing council opinion that is actually split, right? So when she stands up and delivers her remarks, she has to find a balance. And in one press conference, she sort of tilts a little bit to the doves, and another press conference tilts clearly to the hawks. So that becomes a bit confusing for the general public to understand. The bottom line is that with inflation this high in Europe, the ECB doesn't really have much of a choice, and the ECB is operating like a Bundesbank type bank and focusing entirely on inflation. And that's what we're going to continue to see in the next 6 months, most likely.
How much does the China reopening story really accelerate the need for the ECB to remain really tight, really hawkish with respect to their policy?
Yes, I'm glad you're bringing that up. I think I can see you were tweeting about China, and I think it is there's not sufficient focus on how quick the reopening in China is. Everybody was forecasting during some kind of period in 2023, there was going to be some gradual reopening, right? And what we're actually seeing is that we have pretty much full reopening within a couple of weeks. Like the timetable is massively accelerated. And that means we're going to get probably a peak in COVID cases imminently, right? It's COVID is actually pretty easy to forecast if there's no government intervention. It runs a certain cycle. And then we're going to have mobility behavior on the ground change again within the next 1-2 months. So China is going to have a pretty big bounce in consumption activity over the next few months. And that's going to be a big impact on commodity markets. It's going to be a big impact on certainly growth in the region. And that has implications for everything. The most important driver of global markets has always been growth. Right now, we have competition from inflation, but growth certainly matters, and China is super important in that regard still.
Aside from possibly giving a big pop to oil prices, what other implications are there for global markets that are underpriced right now?
Yeah, so I think it certainly makes the challenge for central banks harder, right? All the central banks that are looking for some kind of peak in inflation, some kind of anchoring of the terminal rate, right? If they have another inflation impulse that is coming from higher demand out of China that has been incredibly depressed, that's going to make it much harder for them to call when we actually have a turning point in inflation. So it makes these central banks that want to get more stable on rates, they are facing a much bigger challenge because of this news.
Jens, John emails in. John, thanks, John, for watching today. He's in a bus terminal at Heathrow trying to get to Cornwall. And, I look, Jens, at John's note, and he says he needs to make some money fast. What is the opportunistic pair to speculate in out the next 90 days?
Well, so I think like when you have stimulus dynamics in China and the COVID reopening is kind of working like a stimulus dynamic, crude oil is something that has consistently reacted over the last couple of decades when that happens. And in the currency market, right, you have certain currencies in Asia that really benefit from stronger growth. In China, that would be the Korean won, Australian dollar. And then the places that really benefit from tourism would be Thai baht. So those would be three I've mentioned that directly relate to what's going on with the reopening in China.
Jens, thank you so much for helping us this year. We'll look forward to the next visit. Jens Nordvig with Exante Data today. You know what John's going through, and I think it speaks for so many people on radio and television this morning, east, west, north, south. I mean, everybody's sort of making it up as we go, given strikes, given weather, given capacity, given just a seat sold. I'm supposed to be leaving here in a day or two. I'm not going anywhere.
Well, yeah, they're changing their plans. They're not necessarily going. How many people have I talked to who were supposed to go away or who would normally go away, who don't want to this year, or who are driving and not flying simply because it is incredibly expensive and it is incredibly volatile, considering the fact that more than 1,000 flights were canceled because of this cyclone, this bomb cyclone.
And what John told me, he's going out to Cornwall, which is tippy like palm trees or something in the United Kingdom. And he goes from Heathrow through Exeter, and I had no idea. It's 6 hours to Cornwall on a bus. I had no idea.
It's not taking a bus. Far. I guarantee.
No, he told me. He said he can't get a car. The train's on strike, so he's taking a bus to Cornwall, which I think is,
It's a new TV show.
It's 6 hours, 57 minutes. It's extraordinary. John, safe travels. Futures -6, Dow futures -66. We've got all sorts of great guests. For you, with your worries of the stock market, Jonathan Golub joins us. That at 7 a.m. Must watch, must listen. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. UK household income fell for a fourth straight quarter, leaving Britons on course for the worst period for living standards in memory. Adjusted for inflation, disposable income per person declined 0.5% in the third quarter, according to the Office of National Statistics. Gross domestic product also fell. Economists say the cost of living squeeze has likely already pushed the UK into a lengthy recession that may last until the end of next year. A new analysis shows China is likely experiencing 1 million COVID infections and 5,000 virus deaths every day. That's according to Airfinity, a London-based research firm that focuses on predictive health analytics. Now, meanwhile, Bloomberg has learned China plans to cut quarantine requirements for overseas travelers in January. Under the new rules, the requirement to spend time in a quarantine hotel or isolation facility would be scrapped, and arrivals into the country would instead be subject to 3 days of monitoring. Overseas arrivals currently isolate for as many as 8 days. Tesla is offering a $7,500 credit and 10,000 miles of free supercharging to U.S. customers who order a new Model 3 or Model Y by December 31st. That's according to its website. The carmaker was previously offering a $3,750 credit, which certain Teslas were expected to be eligible for as part of changes to the federal tax credits for electric vehicles under the Inflation Reduction Act. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
this struggle will define in what world our children and grandchildren will live, and then their children and grandchildren. It will define whether it will be a democracy of Ukrainians and for Americans for all. This battle cannot be frozen or postponed.
Very interesting day yesterday. Anne-Marie Horton way out front on this story, saying it was a stunned Washington to learn that Mr. Zelensky of Ukraine would visit. Lisa, what I noted here, and it was so important to allude to Churchill, Roosevelt, August of 1941, floating off Newfoundland, where the United States had to simply say to Britain, "We'll be there." Something like that happened yesterday.
There was a pledge to help Ukraine and to continue helping Ukraine no matter what as a result, not only to help in the war against Russia, but for some of the issues that he put out there for democracy. Question is, the bill was actually delayed last night. The $45 billion in aid as part of this entire package that's getting caught up in Washington, D.C. end of the year drama. So we shall see how things unfold.
Part of the drama and the leadership here is Tony Capaccio, who's our expert on weapons for Bloomberg and also alluded to in the Washington Post this morning, is who wants what. Anne-Marie Horton briefs us on the path forward for Mr. Zelensky and, for that matter, the President of the United States as well. They're not going to get M1 Abrams tanks. They're too fancy. They're too complex, Anne-Marie. But what are they going to get into? Does Europe have Mr. Biden's back?
I think it's pretty clear Europe does have Mr. Biden's back, the president's back, but this president is the one that is really at the center of keeping this alliance strong and steadfast. It's the reason why President Zelensky was in Washington, D.C. yesterday. He was not in Berlin. He was not in Paris. He was not in London. He was not in Brussels. He was in Washington because Washington is the only place that can really make sure that Ukraine is going to continue to get everything it needs. And what the big thing, obviously, and the takeaway from yesterday is the Patriot missile system. And obviously there was some tension in that press conference. You're looking at the pictures there because he says, "What do you ask for next?" And Zelensky joked, "Well, another Patriot missile." I mean, the biggest takeaway from Zelensky, whether or not it was the press conference or his speech at the joint session of Congress, is the fact that it was, "Thank you so much. We are very gracious, but we need more."
I spoke to General Kimmett yesterday of tangible military experience, and Anne-Marie, he was heated. Don't prosecute a winter war. With this success, does Mr. Zelensky want the weapons, including Patriot missiles, now to attack or defend in January and February, or can he wait for the advised spring offensive?
Zelensky wants whatever he can get his hands on immediately, and that was pretty obvious yesterday. I'm unclear on the timeline that Patriot missile battery is going to be able to get into Ukraine and be operational. Remember, Ukrainians need to be trained on this, but it is that type of weapon he wants. And the president said yesterday, this is a defensive weapon. And the president alluded to the fact that what Putin is doing, and the president's words were a weaponization of the winter. They want to be able to shoot down these missiles and drones that are attacking their civilian infrastructure. And that is going to get worse in the winter because it's the winter time when you're really desperate and need electricity and heat and clean water.
Anne-Marie, at the same time, even after the warm welcome by Washington, D.C. of Vladimir Zelensky, they did not pass the $1.77 trillion omnibus bill that included the $45 billion of aid for Ukraine. What's the holdup?
They didn't pass it yet. Let's see what happens today. But they were supposed to vote yesterday, and what you have is Senator Mike Lee wants to put forward an amendment. This would be about Title 42. What they want is for Title 42 to continue. This was the pandemic era provision and restriction that if you were an asylum seeker crossing into the southern border, you can be expelled immediately to Mexico. The Republicans want this to come to a vote. The issue the Democrats have is even if some Democrats in the Senate could sign up for this or allow this amendment to come in, this would be, as one aide put it, toxic in the House and would not pass with the progressives they need to get on board to pass this bill. Because remember, House Republicans are lining up against this bill. So this is a big hurdle right now for this bill. but potentially we will see. They have been negotiating, and I believe it was Senator Schumer who said they are getting closer at around 2 a.m. But this could potentially extend into next week, and then that would mean more likely you would get a stopgap funding measure. But they are going to be working on it today.
There's a broader issue here, Anne-Marie, which is the question around immigration and whether or not to open up immigration much more, especially in light of the labor market shortages that we've been talking about nonstop this year that have fueled some of the wage gains that some people are concerned could become a wage spiral. Is there bipartisan agreement on opening up how many people are allowed in?
Well, Kirsten Sinema is trying to work on this alongside Senator Thune to try to get a bipartisan immigration reform. Listen, it doesn't matter. Republicans, Democrats, many have spoken about the need for immigration reform. But when it comes down to the details, this is something that has been very tricky and difficult for a bipartisan way to get passed forward. But Lisa, you bring up a point, which is that we are facing a very tight labor market, and many have been calling for at least a readjustment in the immigration system because the United States needs workers at this time.
How does immigration policy change, say, January 15th?
Well, I think it'll just become much more difficult if the Democrats were able to get an immigration policy through that needed some Republican support, because come January, this is now a divided Congress. You have a democratically held, controlled Senate and a Republican House. What also changes is that at this moment, Title 42 is about to be lapsed, and that's what the Republicans are trying to change.
Anne-Marie, thank you so much. Anne-Marie Horton will continue this discussion, particularly on history made in Washington yesterday. We'll do that in the next hour as well. Lisa, I want to look at the 10-year yield suddenly, 3.64%. And, I don't know, are we sleepwalking into next year where we're going to revisit that tension above 4%? Remember, we're even modeling out 5%. No one's looking for that.
Especially the oddity here, and I feel like a broken record. Just a month ago, there was analyst after analyst saying that the one bear case for bonds was if Japan abandoned their yield curve control and if China reopened. Both things appear to be more likely than ever, and yet we have not seen a material move up in yields. It is a question that I think is the question heading into the first month of next year.
You were quite taken by the pageantry yesterday in Washington.
Well, this is his first visit outside of Ukraine since the war started. This is his plea for more aid, for more focus on trying to end this as they head into a difficult winter. And it is notable to me, the pageantry coming at a time of war for the rest of his people.
I was thunderstruck yesterday, and maybe I missed this, folks. I did not see a lot of the evening news work, but to me, it harkens back to Southeast Asia and action by democracies over a domino effect. And this time the domino effect, it's a little different, but it migrates from the south and on the Black Sea up to Estonia and maybe even across to Finland. I'm not going to go there. But from Kyiv to Tallinn, and that's why we're doing this. And I just don't think that was discussed yesterday. The idea of the West and of President Biden, we got to get out front on this now for short money to protect that line going north.
The trade lines, the question about the alliance lines, the strategic lines, this is all shifting.
Alliance lines, well said.
And, what we're seeing is not only are some of the alliance lines shifting, but the trade lines. There was a story about how there's a new route being created between Iran and Russia through the mainland in order to avoid some of the sanctions. The world is changing, and that, I think, was highlighted by some of the discussion yesterday.
Right.
This is going to be an ongoing conflict with ongoing ramifications.
There's different roads on that. To let you know, in our first announcement, our annual visit with Ian Bremmer, look for that. We'll do that early in January with his Eurasia group. And I'm sure Dr. Bremmer will talk about the many roads out there and how they change. We will change by telling you that the data today, red and green on the screen, futures at -9. The VIX with a 19 print earlier. Stay with us. Good morning. Good Good morning, everyone. Lisa Abramowicz and Tom Keene, John Ferro on assignment. We welcome all of you here sliding into the holiday season, but with that, some serious information flow. Bloomberg News reporting this morning the quarantine eases up in China. We'll have details on that through the morning as well. On the data front, I'm going to call it a churn of the market, but clearly an accommodative Bloomberg Financial Conditions Index, something Chairman Powell does not want to see. Dollar churning here as well. The yen, as Lisa mentioned, off that history move of the few days before, 132.13. Maybe it's stasis in a Bramo kind of way. This is a joy. We welcome Peter Hooper. He is Vice Chair of Research at Deutsche Bank, but far more than that, team leader for the greatest economic call of the year. Rarely do you put together a directional call with a timeline. Under Dr. Hooper's guidance, Deutsche Bank made a mistake and did both 9 months ago and absolutely nailed that the recession would happen later than sooner. Peter Hooper, congratulations to you and Matt Lazzetti on that call, which appears to be still in place. Review why the recession is delayed.
Tom, the recession is delayed primarily because of the lags in the effects of monetary tightening on the economy. We've known for quite some time that monetary tightening operates with long and variable lags, shortened a bit by forward-looking financial markets, except the financial markets are not playing the role that you would normally expect here. Their financial conditions have tightened some, but not enough. We still see quite a bit of momentum in consumer sector and certainly in the labor market.
Are we beyond pandemic shock? Are we beyond various and sundry supply shocks?
Well, we're living with the aftermath here, and certainly seeing a shift, a recovery in services spending that was depressed for substantially by the pandemic. That's still coming back, and that's still supporting consumer spending significantly. So the recovery is a factor that's working against the Fed right now, trying to deal with inflation. The services, the supply side of the economy has improved enough to reduce inflation pressures on the goods sector. In fact, we're seeing goods prices declining now. It's the services side and the catch-up there that's really driving this momentum that's keeping the expansion going quite a bit longer than perhaps the Fed would like to see it.
Deutsche Bank predicts that U.S. equities could drop 25% from current levels in the next downturn, particularly in the first half of next year. Is this going to be entirely induced by Fed policy as people realize just how committed they are?
Yes, Lisa, I think that is the primary factor underlying that call. Certainly, as you go into recession, multiples get down to around 15. That would imply an S&P 500 getting down to around 3,000 at the low. But we also expect the recession to be relatively short, maybe several quarters, and you'll see a recovery before you get out of the recession. The stock market should be back by the end of the year. Close to current levels if things work out as our call anticipates here.
How do you push back, Peter, against people who say that we're already seeing a deceleration in activity? We're already seeing a deceleration in consumer appetite to spend. We're already seeing a disinflationary impulse that will give the Fed breathing room that has created a shift in tone from Fed Chair Jay Powell. How do you push back and say, no, that is not what you're going to be focusing on come next year?
Well, I mean, I think that view is driven in part by this recession we're already seeing in the goods sector. Goods spending got way above normal. That's come off now. But it is the recovery of services, which is more than 2/3 of the economy, that is going to keep things going. You push back because the labor market is still very, very tight, as Chair Powell keeps saying. We have a long ways to go to get pressure out of the labor market. The Fed has been saying now that it thinks that the NAIRU, the natural rate of unemployment, has been moving up. We've been saying for some time we think it's in the 5.5% range. So we're going to have to get at least to that level to begin to relieve the pressure in the labor market to bring wage inflation down from levels that is supporting inflation at least double the Fed's target at this point. So that's the struggle. I mean, the pushback is not too difficult when you look at the labor market and you look at consumer spending on services at this point.
I feel like this has been the story for a couple of months now. And I'm really struck by the lack of attention given to the fact that there has been two big sea changes that people were looking at as potential tail risks for next year. The potential abandonment of yield curve control by the Bank of Japan, which hasn't happened yet, but there has been signs that perhaps that could happen, and a reopening of China, which seems to have already been done in full force. How has that shifted your view, considering that both of these things seem to be happening faster and more rapidly, more suddenly than people had expected?
Well, it was really interesting to watch the Bank of Japan's move this week. That was a surprise. Surprise that they would take a risk in breaking the dam a bit at a time when the labor market in Japan is really very tight, we think, and wage inflation there is going to be driving price inflation perhaps above levels that are like something very unusual for Japan at this point. But no question, that is a factor down the road. We don't expect YCC to be abandoned until new leadership comes in around April next year at the Bank of Japan. On the opening in China, certainly that's going to be disruptive for a while. No question, the pandemic is going to be a factor that holds back activity for the near term. We're expecting growth in China to remain relatively subdued well into the year ahead. But then as they hopefully get improvements on the vaccination side, on vaccines, things will be able to open up more normally.
Peter, I went back and actually looked, and we spoke to David Folkerts-Landau on March 2nd last year in the shock of a Putin invasion. And he was heated that down the road there would be a great rebuild in the shock of fiscal stimulus. Now, obviously, it's not there right now. Some would say there's even elements of austerity. But is the great unseen out there that can give us optimism is almost spending on a post-World War II level?
Well, when you're talking about packages of $40 billion in support for Ukraine, certainly from the Ukrainian standpoint, there is a major rebuild coming. Although we have the end of this war is not in sight at this point, and it's going to be destructive for some time to come, I would think. But looking beyond, yes, from a Ukrainian standpoint, there is a major push coming down the road.
You mentioned Japan earlier with Lisa, and there's still the shock of the other three major central banks. What should we look for? Not so much the next meeting and the parlor game that you force Lazzetti to look at every day, but in a broader sense, what is a central bank strategy to get to the summer or the autumn of next year?
Well, I mean, I think both the Fed and the ECB are dealing with, they have some headwinds in dealing with the inflation problem. Headwinds and financial conditions are not yet getting to the point that we're going to see the amount of slowdown, the amount of pressure coming off labor markets that needs to occur. Same for the ECB. I think Christine Lagarde gave hints that the ECB could see another 2 to 3 50 basis point rate hikes, pushing the terminal rate in Europe above 3%, potentially. Our call has been 3%, but we certainly see the risk to the upside there. Likewise for the Fed. Matt's call for some time has been 5.1 on terminal for the Fed, but with upside there, certainly if financial conditions are not moving in the direction we need to see them moving, and if the labor market remains firm, the Fed could well be pushing into the 5.5% plus range as we get into late spring, early summer.
Dr. Hooper, thank you for visiting today. Peter Hooper is Vice Chair Research for Deutsche Bank as well, working with David Folkerts-Landau on a world-class team, I should point out. Lisa, let's drop on oil here right now. I think it's one of the biggest shocks of the year. I was trained never, ever forecast oil. It is the toughest thing to call on, and yet people have it at Deutsche Bank and other firms. They have the legendary Adam Szymanski decades ago, but others, Paul Sankey was there, and Curry. You know the names and victims. What a stunning year for oil, 120, 130, oops, down to 80.
I know, it's just sort of shocking, especially considering that people were talking about $120 to $125 a barrel of oil by the end of this year. Also, kind of piggybacking on that story, especially ahead of the travel weekend, gasoline prices now $3.11 on average around the United States, which means it is the lowest going back to the summer of last year. Just giving you a sense of the shift and the sort of unexpectedness of this.
Then why do car rentals cost so much?
Oh, that's a whole other story.
Yeah. To me.
Supply and demand.
They come in with a number and you're like, well, that's okay. And then you give them back the keys.
Well, yes, they have gotten really expensive.
Changed.
Well, you understand. Well, part of this is also just because they didn't have the same shipments of cars during the pandemic when nobody was traveling anywhere.
So you bought their line, huh?
So
we have a shortage of cars?
Well, they stopped buying as many, and the resale values of the cars that they did buy were very high, so they continued to replenish their fleets. And now there just are a certain number of cars, and everybody wants to have experiences.
Yeah, somebody asked me the other day, did I get rid of the Nash Rambler when used cars went up? And the answer is I didn't. It's still in the garage. It's got the chains on it. I'm ready for the snow.
Oh, good.
But, usually Carl Weinberg, the great Carl Weinberg, I'll get the Nash out and go up to Taconic there. And it's like,
when was the last time that you put chains on your tires?
Oh, it was, I probably in the park. Folks, you really want to know? Okay, we're going there right now.
Okay, yes, please.
In the parking lot of the Wobbly Barn. And yes, I was putting the chains on. I was a little wobbly as well.
I'm shocked. And that was the last time. I'm sure that there's a reason behind the last time of chain
did that
arrangement.
I think John Poussette Dart was playing. I can't remember exactly.
Yeah, well,
chains.
I'm going to be probably using some of those this weekend.
Are you?
Yeah, in snowland.
Travel safe. We hope all of you.
Yes, please, everybody be safe.
All of you travel safe. I'm seeing some images out of Logan and others on Twitter. I guess it is a hectic airline season. We'll talk about that. Hey, thanks Helene Becker for her briefing on airlines.
It was depressing.
Mary Schlangenstein as well. Yeah, it is.
It's going to get worse. It's going to be more expensive.
It's a
Why
great
even
country.
Try?
Why is it like this? Is a good question. Futures -8, Dow futures -79. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hospitals in Shanghai are struggling to cope with the number of COVID patients, with many pharmacies turning away customers. Months after the city of 25 million endured a brutal lockdown to stop the virus from spreading, COVID is making its way virtually unchecked through its population. Most of Shanghai's schools are now closed and public transport usage is plummeting. BHP has made a binding offer to acquire Australian copper producer Oz Minerals for $6.4 billion. Now, the deal is set to consolidate BHP's position as one of the world's largest producers of copper, a core metal in the clean energy transition. And BHP says the bid will now go to shareholders for approval by early April. In London, pubs and restaurants say last week's rail strikes cut their sales to almost half pre-pandemic levels. Trade group UK Hospitality says revenue was down 46% compared to the same week in 2019. Industrial action in sweeping the UK with walkouts by the workers in Royal Mail, health sector, airports, and various parts of the civil service, as well as those by rail and bus staff. More transport disruption is expected over Christmas and into the new year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Putin has no intention of stopping this cruel war. And the United States is committed to ensuring that the brave Ukrainian people can continue to defend their country against Russian aggression as long as it takes.
The President of the United States, really history made yesterday. Thank you, Anne-Marie Horton, for getting out front on that story yesterday morning. I think we did a great job, including General Kimmett on short notice to give us perspective as well. Lisa Abramowicz and Tom Keene, John Ferro on sabbatical this morning. Well-deserved, I would say. He's lost in an airport somewhere. You know, and somebody said to me, they said the hardest part about getting to Cornwall on bus is you get to Exeter and you think you're almost there. And it's just that far. Like, it's almost to France, really, the way it goes down. Anyways.
Merry Christmas. We wish him the best.
No, well, surveillance helicopter is tied up, so he's on a bus to Cornwall. We'll see how that goes. The pride and heritage of Bloomberg surveillance is to find experts for you on issues at hand. Leanna Fix is one of those. A fellow at the Council on Foreign Relations barely describes her knowledge of the odd relationship of Germany with the rest of Europe. That's an important brief right now, particularly after hearing from Mr. Zelensky on Capitol Hill yesterday. Liana, this year for you in international relations wasn't in the textbooks at the London School of Economics. There's no international theory that can explain this. What will be the new theory for the German people after 2022?
That's a very good question. And I think, first of all, Germans have to say goodbye to an old theory, because this old theory that dominated German politics throughout the end of the Cold War and after the end of the Cold War was change through trade, that it is possible to change Russia and also to change China by forging closer economic and trade ties. And for the United States, for example, the lesson from the end of the Cold War was peace through strength. The formula that Ronald Reagan used. So I think for Germans in 2023, perhaps they should look more towards Ronald Reagan and towards peace through strength rather than change through trade.
The moment yesterday in Washington, almost like Churchill Roosevelt floating on a boat in Newfoundland in 1941. I don't want to make it an equivalent, but it's there. What is the equivalent visit that we're going to see of Germany and France? How do the two of them stagger forward in year two of this war?
Well, Germany and France, they do have to catch up. It's not without reason that Zelensky went to the United States first, because the United States is just the indispensable nation in this war. And this visit has demonstrated that the United States is back as the leader of the free world. But this means also that other European countries like Germany and France have not been able to step up to the historic occasion of a war in Europe. At the moment, Europe is very much leaderless. Europe is leaning into US leadership. And of course, President Biden is playing a big role, but it would be good for Europe and also good for Ukraine if both France, Germany, but also Warsaw would play a prominent role as a UGT, as a united Europe in helping Ukraine.
Liana, yesterday a Ukrainian journalist asked President Biden, why aren't you providing more? Why haven't you basically thrown as much as you can at this effort to help Ukraine? And President Biden said, because he didn't want to anger or create fissions with some of the allies, with NATO in particular, and put NATO in a difficult spot. Does that ring true with you?
It rings true, but I think it's only one reason, because there are escalation concerns in Washington when it comes to relations with Russia too. So it's not only leaders in Europe that are concerned that, for instance, wide-range artillery might hit Russian territory and that other weapons might lead Russia to escalate further in this war. This is a serious concern in Washington too, as is the concern about nuclear escalation, which becomes particularly relevant when it comes to the question, how much of its territory should Ukraine retake? So I would say it is a topic for the alliance, but it's also a concern that is heard in Washington. And the nuclear escalation is also a concern of President Biden, who certainly doesn't want to see a nuclear escalation on his watch.
In the meantime, we are hearing about a mass migration out of Ukraine. We're hearing about power outages, a very difficult winter ahead. How much has the population shrunk? How much are we looking at a very different Ukraine coming out of this than coming in?
So we had in Europe, we had 4.7 million registered refugees from Ukraine, but many of those have returned to Ukraine over the summer, which has relieved the burden for Europeans. Now, when we're looking towards this winter, it's exactly the strategy that Moscow pursues to put Europe under pressure by making Ukraine very much uninhabitable and by forcing Ukrainians to seek refuge once again in Europe. And that's a strategy that Europeans try to counter by air defense, which is important. But at the same time, Ukraine needs offensive capabilities to continue counteroffensives.
Dr. Fix, one more question on Germany. Is there a new Angela Merkel out there? Is there someone within domestic German politics that can fill the shoes, the emotion of the heritage of Angela Merkel?
Well, actually, Olaf Scholz, the chancellor now in Germany, was compared to Angela Merkel at the beginning of his term. But let me remind us that Angela Merkel also got this very special appeal, this admiration from the outside world only towards the end of her chancellorship. That was not the case at the beginning. So Olaf Scholz will need 16 years perhaps to get to this point.
Dr. Fix, thank you so much. Greatly appreciate it right now. We're going to digress here, folks, with the Council on Foreign Relations, and they're particularly on Germany. We're going to look at the data here. There's lots to talk about as well, the accommodative tone of the Bloomberg Financial Conditions Index. John Golub will be with us here on the equity markets. But, Lisa, I have to stop, and I'm going to go back to my youth, where long ago, someone very young without a bow tie on had to deal with sudden infant death syndrome. And it was done out of the best university for this in America, which was the University of Washington in Seattle. They've gone on from 50 years from their ownership of the immunology, the virology, the microbiology of that era to owning COVID data. The work there of the IMHE in the last 2 days, and a lot of this is funded by Bill and Melinda Gates and all that, the Washington State funding. Their numbers on China are just stunning. There's no measurement, there's nothing we can grasp here, all of us watching in the Western world, of what's to come in China, basically based on the smartest people on the block, the people at the University of Washington.
So there are a number of estimates that people are trying to put out there because the real data, the sort of state-backed data, I'm not going to call it real, has been basically rejected based on empirical data with hospitals full and with some of the crematoria in full operation. China is likely experiencing 1 million COVID infections and 5,000 virus deaths every day. This according to Airfinity, which is a London-based research firm. The bigger question here is, how long is it going to rip through a population, fill hospitals, lead to deaths, lead to pain, lead to the emotional turmoil that Xi Jinping tries to offset with stimulus? This is sort of the push-pull that we're seeing right now that is completely changing the scenario and the dialogue for China next year.
And to put a compare and contrast on this, folks, is what we do. IHME of Washington made headlines and got a lot of grief from the White House, I might point out, except for Dr. Fauci, when they said 80-some thousand U.S. COVID deaths in 90 or 120 days back in 2020. So take a number like 80 or 100,000 and compare it to the mathematics of 1 million infected and what that death size is in China. We're just literally, folks, into this holiday weekend beginning to gauge the scope and scale of what we see in China.
And the psychology of it. We've gone from lockdowns. We've gone from state testing. We've gone from not being able to go into a public place without having some sort of official document saying you've been cleared on a regular basis. We've gone from quarantining to nothing, to not being able to get tests in stores, to having to have state-run manufacturing of Tylenol to combat the mass infection that's ripping through the population. How does that affect the psyche? Xi Jinping has been quiet. We have not heard from him. What is the response going to be?
Well, maybe we'll in the slowness of the holiday season. May I state that the place that tested me early and often through all of COVID, and literally 12 months ago I think I had COVID, is now a wedding dress store on Madison Avenue.
That sounds about right.
That's where we're going, folks.
Have you seen the new tests where you have 4 quadrants where it's COVID, RSV, flu?
No, but that's a serious issue.
I know.
There's a heavy inflection of that in Western Indiana right now. West Lafayette crushed with a triple infection It's just terrible.
It is.
Probably a visit to Harry's chocolate shop will get it done. Futures in -7. Stay with us. This is Bloomberg.
We are not forecasting a deep and very long recession, but let's not be too optimistic.
This year has been historically difficult, to state the obvious.
I think central banks really need to be careful here.
There's room, I think, for the Fed to step down.
You look what the bond market's telling you. It's telling you the Fed is going to win the battle against inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We welcome you on a Thursday. Claims here coming up an hour and a half. We'll get to that here over the hour and into the next hour as well. John Ferro on assignment at Heathrow, trying to get Southwest.
On assignment? On assignment to what? Relax?
Well, you can't relax if you're taking a bus to Cornwall.
Fair point.
I mean, you know, the helicopter won't go in the London cold as well. We spent a real long hour in international relations. We're going to go stock market for a year. This is going to be must watch, must listen. And Lisa, part of this is the recovery in the markets. June up, down we go again. September up, now we go. I'm sorry, I got a VIX 19 print 20.16. Things aren't all that bad out there.
Here's the big debate heading into 2023. One of them. There are many of them, but one big debate is, will resilience in the economy be good for stock markets or bad for stock markets?
Well, is that it? That's the length of your question today? We
That's,
have
to
have
me, that's the
statements.
question. No, okay.
Fill time.
Whether it's basically, if you get a resilient economy, all of a sudden, people who are looking for an earnings downturn say, great, we buy stocks. But then others say, well, then the Fed has to jack up rates by a whole host of percentage points. So suddenly we're looking at a sudden halt to the economy. Which is it?
The Gospel of St. Martin Adams, and Gina Martin Adams stating forcefully, economic analysis linked to stock market analysis fraught with risk. They don't move together. They move different ways, and some would say the equity market is out front on that as well. What I would suggest is profit is at hand, and that's when you hear this word quality, and that people are looking mostly there. Are they making money? Are they making money?
It's the haves and the have-nots. I mean, it's the haves and the have-nots, not just with individuals and households, but also with companies. You have, on one hand, the companies that are coming out better than expected. Nike, FedEx, and then Micron yesterday, after the bell came out with disappointing earnings, saying they were going to cut thousands of jobs and have to really retrench and not see profitability next year because of the glut of semiconductors. It is just a very bifurcated kind of world with different stop-start recoveries.
Let's bifurcate to the view that you have this morning here, because we got to get John Golub in here. What do you say?
All right, 8:30 a.m. You mentioned this. We get the third reading of the U.S. third quarter GDP, initial jobless claims. That'll be interesting just to see whether we see another unexpected decline, downside surprise in the number of people filing for unemployment benefits. 11 a.m. We get the Kansas City Fed's manufacturing index for December. Do we see the optimism we saw for consumer sentiment yesterday bleed into manufacturing activity? And I am looking at the weather today just because, first of all, there's not a lot going on.
This is the first day I've said yes.
I mean, honestly, this is going to affect heating costs. This is going to affect travel plans. More than 1,000 flights have been canceled ahead of the holiday weekend. A bomb cyclone is coming. And I knew you were going to make fun of me for saying that, but I've got to be honest. It's a technical thing, and it's a sudden shift.
They played Grand Funk Railroad like no one.
Bomb Cyclone
was so great. You get a Jenny 12-horse ale in your hand, and Bomb Cyclone would start in.
So for all of you who have garage bands, Bomb Cyclone is a fantastic name, which apparently is available. I do think, though, this is relevant because it is going to affect people's view. Also on heating at a time when gas prices have gone down so much, but diesel still remains elevated.
We bust the chops of John Ferro, who can't take the cold of America, but really this weekend, 19 degrees in New York City. It is going to be bitter cold coming in from Fargo in the west.
Okay, look, Fargo weather, let me just tell you, it is a whole other degree of cold.
It
you
is.
Come out, you can't breathe. Your car dies. You can't use pens because the ink freezes. You can't be outside with exposed skin because you get frostbitten. It's a different reality. But if the wind doesn't blow, you're okay.
And what's important here is, as you mentioned, Bomb Cyclone and what they did with Grand Funk Railroad. That takes us back to 74, 75 and the equity gloom back then. Someone who studied that, he's way too young to remember it. Jonathan Golub joins us, Chief U.S. Equity Optimist at Credit Suisse. We're thrilled he could join this morning. I'm going to get to your revisions, your markdown on earnings in that. But the answer's after 74, I believe it was. We went up 38% the next year, and critically, then the year after that, we went up another 18%. Is that the great surprise out there? Is an equity liftoff out there somewhere?
Well, I think it gets to something that Lisa was saying is what's good news. I mean, right now, the backdrop is just becoming much more positive with respect to this idea that there's no recession coming in the next 2 or 3 quarters, and the market getting their head around that, which is why the VIX has fallen and why stocks are racing ahead. Now, the problem is eventually this does bite us in terms of 2 things. First of all, companies are, as inflation is falling, companies are losing pricing power, and that's not good for margins. So a resilient consumer is actually a little bit of a headwind for profit margins, which is strange. And then ultimately, this inflation doesn't magically go away, which is also a problem.
You marked down earnings, okay? You're doing tweaks here in the outlook. You got a 50-page outlook. I didn't read it all. I read part of it. Do you know the watermark that they have for us so that we don't steal their research?
Yeah.
Do you know what his watermark said? If this research gets out, we take away my eggnog. I couldn't believe Credit Suisse did that. The compliance department at Credit Suisse did that. I want to know if profit's a place to hide. You were way out front in the bull call of selecting certain sectors, certain stocks. Does profit save me if I have to own stocks?
I don't think that's the way you should be looking at it. And you're talking about, Gina's comment that what happens in the economy doesn't necessarily happen in the stock market. What happens last year, corporate profits, the outlook improved throughout the year, and the stock market had a terrible year because interest rates rose and other factors like that. I think this year is going to be a little bit different. I think that you actually have margins. Margins are going to get squeezed, and I think it's going to be tougher on profits. But I think the stock market is going to be a little bit better on it.
Like how much better? Double digit?
No.
John, it's a slow day. I need to make some news. Let's go.
No, I think it's going to be a more modest returning year because I think that you're looking at something like down 4 or 5% profit growth, even if you don't have a recession because of a margin squeeze that's coming.
Have the companies that have already done the layoffs, and I'm thinking of tech, I'm thinking of certain industries, even the banking industry is starting to do some bigger rounds of layoffs, and of course the semiconductor industry. Are they going to be in a better position, or are they just a tea leaf for what's to come?
Well, first of all, when you look at and a lot of guys on Wall Street talk about all these layoffs because they're looking at tech and financials. But in reality, the job market is just swimming in unfilled jobs, and demand is incredibly high. But what the story is on tech in particular is that and Tom was talking about profits. It's not one profit picture. The tech universe, if you include the Amazons and the Googles and the Facebooks and the like, it's been a horrific environment. They've substantially lagged the market. Their estimates are being revised lower and lower, and they're missing the lowered estimates as a group. And their outlook for growth, it was weak. This is since the iPhone came out in 2008. This is the worst year for tech-related companies that we've seen. The expectation is that next year we're going to get this big bounce in tech earnings as we get, we had this big pull forward. We're all staying at home. We're buying, stuff. That lull afterwards is going to last longer than we think.
Are you telling me to sell Apple? I mean, I don't own it. I'm in the triple leveraged all cash fund. We know that. But are you telling people to sell Apple along with all the other challenges Cathie Wood has?
What I'm saying is I think that this problem that we've had in tech is not a sentiment problem. It's an earnings problem, and it doesn't last for 3 or 4 quarters. It lasts for 6 or 8 quarters. And a lot of these big tech companies that 2 or 3 years ago we said they have moats, they're impenetrable, and we talked in those terms. A lot of those companies are getting closer to total addressable market, whether that's in handsets or advertising or other things like that.
So how do we get to 40-50 by the end of next year, given that you're expecting perhaps a bit more softness and tech not leading?
Well, there's other areas. So I think that energy, where there's this expectation that you're going to have a weakness in energy profits, I think is going to be totally wrong. I mean, we're seeing this right now that in the last 6 months, the earnings estimates for the energy sector keep getting revised higher and higher, even though oil prices are falling. So, like, where's the magic there? And it's a lack of refining capacity. And if we do end up with oil prices rising, a bit because the economy is a little bit stronger and China reopens, then these companies soar.
Right.
So I think that's an area of strength that's probably underestimated. Tech, on the other hand, to the downside.
I didn't know this. I mean, folks, years ago, Credit Suisse was absolutely definitive on energy infrastructure in the United States. His name was Mark Flannery. He's over with Steve Cohen buying New York Mets bodies at 0.72. You guys own the high ground. I don't think a lot of people know this. What does the subsets you have of energy tell you about the great energy bet in the stock market?
Well, I mean, and we're talking, it's interesting. If you look at U.S. energy company or North American energy, you have each of the pieces separately. So you have companies that do refining and companies who do distribution and E&P. If you're looking at the big majors in Europe, they're just big fat oil companies, and you have less of that granularity that you see that you
his
in the
next
US.
trip to Paris is going to be great. I'm here with the big fat oil companies.
No, listen, you have the same thing in the U.S. with our big integrateds, but we have a lot of, and you can see that those refining businesses are just levitating on lack of refining capacity, and nobody's putting it in. So if you do have oil lift off, and then you actually get some upside in the more commodity-sensitive stuff like the E&P name and the service names, the sector is going to be a really big surprise. It's absolutely our top pick. The second area, at least we're talking about, is the consumer. Just think about what's going on. Their wages are staying higher, and the inflation on the things they're buying is falling, and there's an abundance of jobs. Right. Consumer confidence, and we've seen this now since June and July, the consumer confidence data is ripping, and people aren't appreciating that the consumer is going to spend a lot more money. It's going to keep us out of recession, and that's another area.
That's the Golub optimism I see, and as you mentioned, he only gets to 40-50.
Yeah, but that's exactly it, right? I mean, even with optimism, the case is converging on some of the bearish sentiment that we're seeing from elsewhere. I will say, America's going to shop. That's basically the takeaway that I heard. They've got money, they're going to spend it.
Okay. John Golub, thank you so much. I guess we'll see you soon if you're not in Paris being beaten to death by big fat oil companies, is what he said.
You make the holiday season sound like so much fun.
They have big fat dividends over in Europe,
they do.
To be honest.
And they're coming back in the U.S.
It's an extraordinary policy. Jonathan Golub is with Credit Suisse, and we thank him this morning. Futures -6, a VIX with a 19 print, back to some form of optimism, 20.18. Please stay with us. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Bloomberg has learned China plans to cut quarantine requirements for overseas travelers in January. Under the new rules, the requirement to spend time in a quarantine hotel or isolation facility would be scrapped, and arrivals into the country instead subject to 3 days of monitoring. Overseas arrivals currently isolate for as many as 8 days. U.S. authorities allege fallen crypto titan Sam Bankman-Fried defrauded investors in his FTX empire, stealing billions of dollars over years for his own benefit. Now, top Bankman-Fried associates Caroline Ellison, former CEO of Alameda Research, and Gary Wang, co-founder of FTX, are accused of helping him. They pleaded guilty to federal criminal fraud charges and are cooperating with prosecutors. The U.S. Securities and Exchange Commission and Commodity Futures Trading Commission also announced separate lawsuits. More than 3/4 of UK businesses surveyed say the government's Brexit deal has not helped them increase sales or expand. According to the British Chambers of Commerce, Brexit has damaged the ability of companies to compete in the EU, with businesses, quote, banging their heads against a brick wall. Well, the research is published on the second anniversary of the agreement between London and Brussels. And Tesla is offering a $7,500 credit and 10,000 miles of free supercharging to U.S. customers who order a new Model 3 or Model Y by December 31st. That's according to its website. The carmaker was previously offering a $3,750 credit, which certain Teslas were expected to be eligible for as part of changes to the Inflation Reduction Act made to federal tax credits for electric vehicles. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The Southern District of New York has filed charges against Caroline Ellison, the former CEO of Alameda Research, and Gary Wang, a co-founder of FTX, in connection with their roles in the frauds that contributed to FTX's collapse. Both Ms. Ellison and Mr. Wang have pled guilty to those charges, and they are both cooperating with the Southern District of New York.
The gentleman of the legal system in New York, Damian Williams, U.S. attorney there. The phrase in the zeitgeist this morning, not from Bloomberg News, but from other sources, is the throwing under the bus, with two more people brought in on this scandal, if you would. And Mr. Bankman-Fried, somewhere, is he in the United States?
Yeah, he's arrived in the United States after agreeing to be extradited.
Okay. You know, I have, to be honest, I have not followed the last 24 hours, but it is a movable feast, and we're going to get an update and briefing. Lisa Abramowicz and Tom Keene in New York, John Ferro on a sabbatical somewhere between Heathrow and Cornwall. Anna Herrera joins now, spearheading our coverage on crypto off the London desk, and that's important, folks, because this is not a U.S. story. It is truly a global story as well. And I want to get to Binance in a minute, which is fermenting, but on FTX yesterday, simply, what did we learn?
Well, obviously, we learned, first of all, we learned that, you know, he wasn't doing any of this alone, right? His top lieutenants pled guilty. And we learned a bit more about what was going on behind the scenes. And it seems that, you know, as other firms, they got swept away by the collapse of Terra, which was this big stablecoin project, and Alameda Research, Sam Bankman-Fried's hedge fund, sort of got dragged down, didn't have any more money to repay lenders. And so regulators alleged that they got money from FTX customers, and that there was really never any separation between the funds of the two firms.
It may not be language you would use, or reporters in New York, but the phrase is thrown under the bus. Are the legal authorities setting up these secondary officials to, and I'm saying this, folks, with quotes around it, to get Bankman-Fried, or is that too unsophisticated of an analysis?
Well, you know, you obviously will get more if the people that worked with him talk, but they've also said in the same video you were showing later on, the district attorney reminds people that also work there, you know, if you know more, now is the time to come talk. Our patience is not unlimited, which is quite eerie sounding, right? There were other people that work there, and so I guess the more information they can get will be good. And we're waiting to see if Bankman-Fried, that now is in the U.S., will plead guilty to, or what will happen.
Anna, how much pushback is there to this idea that Sam Bankman-Fried will get a bail deal, will be able to go out on bail once he comes to the U.S., which my understanding was one of the ideas of returning to the United States?
Well, I guess it depends pushback where. Obviously, if you look at where the crypto crowd expresses their feelings on social media and Twitter, mostly, I imagine a lot of people won't be very happy because, you know, for many, this was the latest hit. A lot of people in crypto had money in FTX. And so, you know, this was a big shock for everyone. So they might not be super thrilled if he gets to go out on bail, and the bail isn't very high. But, you know, we have to see what happens.
I'm going to ask an unfair question because it's something that's been fascinating to me as I've read through all of the documents. Someone who was raised in a privileged home, the son of Stanford professors, had every privilege available to him. What was the psychology that people are talking about through why you would perpetuate a fraud like this? What was the purpose?
I wish I had the answer to that. I don't know. You know, we wrote about some of the conflicts or potential conflicts we thought between the two firms in September, and we'd spoken to Sam Bankman-Fried and Caroline Ellison, and they assured that there was separation between the two firms. So now to see what was going on behind the scenes is quite jarring for us too. But, you know, I'm not a psychologist, so I don't know what was going on.
And I want to get out front of next week. And next week to me is Binance. I've been following this, frankly, folks, far, far larger than FTX. I've been following the Binance story unfolding. You have the advantage of being in London, where we don't even know really where Binance is domiciled. There's, you know, talk of Cayman Islands, but who really knows? Should we be focusing on Binance?
They're the biggest exchange by far now, right? And historically in crypto, big exchanges have had ups and downs. Some of them have resisted. So obviously it's kind of legitimate to start asking questions about Binance, not because necessarily there will be something bad, but because it is fair to ask questions. And even as we've seen, clients have started pulling money from exchanges because they're concerned that something will happen like it happened with FTX, Celsius, Voyager, all these other firms before them. So, it is perfectly legitimate to start for the public to look at what remains standing.
Anna, thank you so much. Anna Herrera with us with Bloomberg News in London, a brief here on crypto forward. Lisa, I think this is a huge deal. You and I have to be so careful about the innuendo, the speculation, the rumors out there. We're not in that business. Bitcoin 16,800, I guess like a rock is how I'd put it. But I'm intrigued by the adults out there in the zeitgeist are writing about Binance as much, if not more, than FTX.
Especially because they've just acquired the bankrupt crypto lender Voyager Digital.
Saw that. Yeah.
And, how much is this trying to be a show of strength that they can continue to be an acquirer, a consolidator of market share? And how much is this something else? Also interesting with the accounting firms pulling away, one of the biggest accounting firm saying that it was going to step back from the crypto industry.
Well, they're doing proof of reserves. This is Mazer of South Africa, which is respected. And they did a sort of audit, I'm going to say, as an amateur. And then, folks, they just stepped away 5-6 days ago. They just said, no, we're not going to do that on Binance. And, again, I go to, the name is not in front of me, the esteemed former SEC official now at Duke University, who said, look, here's the red flags, let's count them. And that's sort of where we are this morning within our reporting. Katie Greifeld, Kaylee Lines, Matt Miller, I think is involved as well. And the crypto show will get there. I guess they do a crypto show next week.
Well, it's the day after Christmas.
How do you plan for it? You start planning Monday, I think, for the story's moving so fast.
Can I shift gears a little bit? Because while we were talking, CarMax.
It's shift gears
By
Thursday.
hard pivot Thursday. CarMax actually earnings came out, which was a huge shift. Those shares are down almost 13% pre-market trading after reporting quarterly earnings that were well short of expectations. And this follows on to your question about why is it so expensive to rent cars, right? And this doesn't give the answer, but it speaks to the massive and quick decline in prices of used cars and how that's filtering in to one of the biggest used car dealership operators out there.
So 10 to 150, back down to 50, back down to where it was 6, 7, 8 years ago.
Yeah, we're talking about adjusted profit, 24 cents a share. The estimate of analysts was 65 cents a share, so pretty significant underperformance, even after downgrading how much they thought they were going to be earning.
Are you front-running your equity report in 6 minutes?
There's plenty else to talk about. I honestly, I find this really interesting because I've been talking about, sure, and we'll just keep going through the break with lots of equity calls. The reason why I find this interesting is because we've been talking about the disinflation. It is coming in pockets. And used cars is one of the biggest pockets and one of the biggest inputs. Vehicle sales are one of the biggest inputs into CPI print. So we might see a deceleration now. And this could be a big part of the reason why.
I'm amazed with the buys and the outperforms on the street.
Are you being snarky?
No, I'm not being snarky.
Holiday season.
I know. Holiday season is I got to get to February in my employment. I'm trying to do that. But, on CarDog, I've got 13 buys, 6 holds, 2 sells. And there's some people that have recently stepped into this thing.
Well, people were thinking that perhaps we'd gotten to the lows, that perhaps we are set next year for car prices, used car prices in particular, to pick back up and new car prices to roll over. Well, this kind of flies in the face of that a little bit, and it's a surprise to a lot of people.
Chris Bottiglieri, BNP Paribas Exane. He looks like a genius right now.
Well, Chris.
He's lonely, but he looks like a genius right now.
Lonely, but a big stocking.
Futures -10, Dow futures -84, the VIX 20.26, yields churning, everything churning, dollar churning, yen on 132.11 as well. Mark Cabana for Global Wall Street, an important brief. We will do that. Mark Cabana, Bank of America. Good morning. Bloomberg Bloomberg surveillance. John emails in. He's 10 miles outside Heathrow on his way to Cornwall. Good morning, John Ferro. He says, Tom, do a full data check for me at least. Let us do that right now. Futures negative 10. Dow futures negative 81. The VIX 20.26. I'm looking at a Bloomberg financial index, which screams accommodation. We'll talk to Mark Cabana of Bank of America about that in a moment. Dollar's given me a churn this morning. Yen, focus there, 132.10. A stronger yen, but not through the 131 handle, which was yen strength off the shock of the week, the Bank of Japan. Oil with a lift. This is important. Lisa touched on this earlier. I'm going to round it up. West Texas Intermediate, 80 a barrel. Brent Global Crude, $84 a barrel. Gold well out over 1,800. Good morning, Dennis Garbin, 1824. The ounce is how they quote that on gold. And curve. The curve is really not part of the story. The real yield, not part of the story. That'll about do it for a data check. The 10-year yield, 3.65%. They're individual stories. Lisa demands that we redux Car Dog from 7 minutes ago. Go.
So I don't know if you've heard about this company, but there's this company called CarMax.
Really?
They just
I didn't
reported
know that.
earnings, and the earnings came out way below what people were expecting. And this is interesting because the reason why this talks to your two Americas. You talk about the deciles of American incomes, affordability issues. It is getting so expensive for many families to afford used cars, especially when you finance them at rates 10, 11% at this point. You are seeing those shares plunge by at one point 18%, now down 12% ahead of the open after that report. Micron also coming in below expectations yesterday, talking about how they weren't going to make a profit next year because of the inventory glut, the sort of push-pull, the start, restart, stop kind of pandemic reality. And those shares are lower by 3%. Western Digital, a competitor, those shares down in sympathy 1.2%. You're seeing that for some of the other competitors as well, including AMD. How much is that going to really be the story that the tech pain continues? Kind of like what John Gollop was talking about through a year, even though a lot of people are expecting some sort of rebound.
Is that it?
Yeah, do you want me to keep going? I can keep talking. I can go
Give me some good news. Do you have like a Nike good news story today?
Nike is still good. If you want to buy Air Jordans for my son, go for it.
Well, I saw I was going to get a pair of the Mbappe, the French.
How much were those?
You can't get them. Ferro, I think, got the last pair. He was seriously looking at them. He's looking at the Diodora red sneakers. I remember those.
He's reprising his childhood dreams terms of his
He
gifts. And he's not alone. A lot of people do that.
I'll look those up. We'll give you an image of those folks on radio and TV.
What was your childhood dream for a gift?
Oh, it was bow ties.
Little Tom Keene with little Hermes.
No, it wasn't Hermes.
No, it was
Yes, I didn't start. I wore a clip until like 2 or 3 years ago as well. Right now, and this is really important, as we talked to John Gollop earlier, there are 219,000 people at the Bank of America. And Mr. Moynihan called in this morning. Only Mark Cabana is working today for the Bank of America. He's global head of U.S. short rate strategy at Bank of America. Thrilled he could find time creeping into the holiday. Let me go to short rates first, Mark. What is the efficacious way to play the fixed income market into next year if I'm scared stiff? How do you do it if you're afeared?
Yeah, well, we think that the path of least resistance is still going to be for the market to try and nudge up the terminal rate at the front end. The market right now is about 25 basis points below where the Fed's dot for the end of 23 will be. And if you're a little worried about the outlook, we think that you want to be leaning long the back end. We think that that is going to be a way to protect yourself against a slowing economy, likely declines in employment, likely higher unemployment rate, moderating economy. And that's going to give the curve still a bit of a flattening bias, at least in the near term. So
Mark,
again, we do think that. Go ahead.
Well, your charm is you speak in English. There's a lot of people in fixed income where you can't understand it, lining up behind Bramo here. The number one question I get from people on the street is how long is it going to take to make up a 15 or an 18% loss in fixed income? And you've got an encyclopedic knowledge on this. Is this a 12-month exercise, an 18-month exercise? How do I get back to break even on fixed income? How long will it take?
Well, it depends on what your benchmark is. But look, we do think that fixed income is going to have increased value for investors over the course of the next 12, maybe 24 months. And that's simply because, again, you're going to be seeing yields that are probably going to be moving lower. You're going to be seeing yields that have value in portfolios again, as they serve as a hedge to risk off moves, where yields, when we see risk off, will go down as opposed to up. So prices will increase, not decrease, as we saw over the course of 2022. And that is going to mean that investors should be thinking more constructively about fixed income broadly, simply because you're going to see that risk off value return to fixed income, which it really lost over the course of 2022 with very, very elevated inflation. As inflation moderates, we do think that that increases the attractiveness of fixed income and portfolios. And the way that we've been recommending clients play that is by being long towards the long end of the curve, viewing the long end more constructively. You could still see yields rise at the front end to some extent if the Fed has to keep hiking over the course of next year. But we do think that the long end, you're going to be somewhat protected, because we expect that most yield increases are going to be bought by investors who see long end yields as increasingly attractive, around 3.75, or should we push back close to 4%? We think that there's going to be a lot of interest from fixed income investors around those levels.
If the word of the year in 2021 was transitory, the word of the year in 2022 probably was pivot or step down or whatever you want to call it when everybody groaned. You could argue there are a couple other words in there. What's the word of the year in 2023 that everyone's going to kind of hang on to as the holy grail?
Yeah, I mean, I think the market's looking for a pause from the Fed. That's going to be at least what the market's looking for from the Fed. The word of the year will probably be recession, or maybe not a recession. Certainly, it's quite consensus that we're going to see the U.S. economy and likely the global economy slow down over the course of next year. And how quickly or slowly that happens is going to really be the focus in markets. Right now, the market is looking for a turn from the Fed, looking for a turn in the economy, it seems, around the middle of next year. And whether or not the labor market cooperates, we think, is really the question of 2023.
So Michael Hartnett, your colleague over at Bank of America, put out a note today where he was talking about the 60-40 portfolio hanging in there, how he likes small cap stocks. And he talked about how bonds should do well in the first half and not so well in the second half. And it sort of coheres with this idea that stocks will do badly in the first half and better in the second half. What happens to that call if the recession is pushed out, if there is this momentum driven by consumer sentiment that has come in much stronger than expected?
Yeah, then the value of fixed income is going to be deferred for a time. Certainly, if we see the economy that continues to do reasonably well, again, you're going to see the front end continue to sell off as the Fed is biased to keep hiking, keep moving terminal more elevated. And with that, you'll probably see the back end nudge up a little bit. The curve will become more inverted in that type of environment. And you'll have to wait a little while to really see that performance in fixed income that we anticipate. Look, the market believes that the Fed is going to be successful in engineering a slowdown. It's just a matter of how high does the terminal rate have to go? How long does it take to achieve that outcome? But we ultimately think that they will be successful. And that's why we continue to have a constructive view on long end duration. We continue to think that 10s are going to be rallying to about 325 or so by the end of next year. And it may take more time for long end fixed income to really perform well. But we do think that you're going to see that performance over the course of 2023. Right. We certainly saw it in the last few weeks of 2022.
Mark, one more question, if I can. Buried in your note is really the tone of the moment. I'm really taken back by this from fixed income strategists. You guys are becoming closet economists. You're looking for, quote, labor cracking. Have we ever done this before? Have we ever modeled our fixed income space off the dynamics of the American labor economy?
I think that probably implicitly we have in the past. But what's different about today in 2023 is that we're all anticipating a recession. We're all anticipating a slowdown in the economy and the labor market. And in order to really see the front end of the curve start to perform, in order to see Fed rate cuts that are going to be pulled forward and justified, you really need to see the labor market moderate. And that's not happening yet. So in many ways, this is the most expected, most anticipated recession ever. And really, you need to see the labor market begin to moderate in order to think that the Fed will be able to pause and eventually then move towards rate cuts.
Mark Cabana, thank you so much with Bank of America. And Brian emails in and says, no, Tom, there's a few more people working at Bank of America today besides Mr. Cabana as well. Long ago and far away, there was a reporter at Bloomberg, and I would go, oh, she can write. Her name was Lisa Abramowicz.
Never heard of her.
Lifetimes ago. The brethren of Abramowicz, the reporter, have a shocking story out of Europe today with a small bank named JPMorgan. This is Donald Griffin, Laura Benitez, and William Shaw. This is the kind of small story that comes out in the cold of December 22nd. Lisa, if you're in CDS and you get the direction call wrong with leverage, bad things can happen.
Yeah, right. What goes up big can go down big. And basically, this story is about a $70 million loss, at least, of credit write-downs on JPMorgan's books that a lot of people are looking at and kind of grumbling about. And to be fair, it just came out, and I'm looking through it right now. But on my first read, it seems like the real story here, the meat, is a relatively illiquid market and a very big market maker, JPMorgan, that can push things around. And that is some of the allegations that people are talking about in terms of transparency and ability to put marks that accurately reflect where they would trade in a free market.
The reason I highlight this, besides it's Bramo's wheelhouse, like seriously, this is the day job for her, is the idea that it's not a lot of money for Mr. Diamond. I'm going to assume he's not staring at the ceiling at night worried about Mr. Canepa and what's going on. It's a rounding error. But this is the game, folks, of price up, price down, yield up, yield down. When you provide it over to CDS, credit default swaps, we don't have time to explain that here. Bad things can happen on a micro basis.
There's also a bigger story about liquidity, and it's an important one, especially in the European credit market, which is becoming a lot less liquid, especially in light of the sudden withdrawal of free money. If you start to have more pockets of illiquidity, people without the willingness to buy and trade to the same degree that they have been, who are the people who push the prices around?
Who's on the other side of the trade?
You start to get some more questions around that typically come out. We heard about this certainly in 2009 and 2010 with portfolios of CLOs and mortgages, and also just in general high-yield bonds, and who is selling them, who is on the other side, who is working together, et cetera, et cetera.
That was really, I haven't seen Bramo that fired up, folks.
Well,
send in your emails and tweets, folks, as you can. Bramo to the core religion of debt structure. Thank you to Donald Griffin and all in London for that report. Stay with us. This is Bloomberg Futures, -12.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. UK household income fell for a fourth straight quarter, leaving Britons on course for the worst period for living standards in memory. Adjusted for inflation, disposable income per person declined 0.5% in the third quarter, according to the Office for National Statistics. Gross domestic product also fell. Pubs and restaurants in London say last week's rail strikes cut their sales to almost half pre-pandemic levels. Trade group UK Hospitality says revenue was down 46% compared to the same week in 2019. Industrial action is sweeping the UK with walkouts by workers in the Royal Mail, health sector, airports, and various parts of civil service, as well as those by rail and bus staff. And more transport disruption is expected over Christmas and into the new year. Japan approved one of the world's first blood test kits to detect signs of Alzheimer's disease. Seismix Corp says its test measures an abnormal protein that jams nerve cells in the brain and is a marker for Alzheimer's. Now the kit will give doctors in Japan an easy, inexpensive, and minimally invasive tool to screen people quickly for the disease, which is currently done through PET scans, MRI, or painful spinal taps. In Spain, one of its most iconic events, the bumper Christmas lottery known as El Gordo, is underway. The most sought-after prize shells out 400,000 euros to holders of winning 20 euro tickets. The incredibly popular lottery will dish out a total of 2.5 billion in prizes, much of it in hundreds of smaller prizes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
still think the preferred habitat is in the U.S. I think Europe has their struggles, of course. They're fighting a different inflation monster. I think the U.S. is, much more on the path of normalization.
Greg Peters on fire yesterday. He is esteemed in the fixed income space. What did we learn from Greg Peters yesterday, Lisa? I thought that was really good.
It's just the difficulty, frankly, and the idea of how tough this year has been and how tough next year will be. This idea going forward that there is value in bonds, but it is not wholesale and it is not just rearing to go at the start. It's the sequencing. We keep hearing that. It's the sequencing. First sovereign, then investment grade, then high yield.
I didn't really pay attention to Greg Peters yesterday because I was doing my Christmas card list. I send out one Christmas card.
I was about to say, how long is the list?
It's just one card. It's one card.
Who's it to?
I take the pen. I'm writing here. Dear, should I call him Mike or Mr. Bloomberg? Dear Mike, comma, thank you. Santa.
Yeah, exactly. Well, thank you for revealing that, Tom. I appreciate it.
It's one card.
Well,
I
was listening.
Can do 2 cards.
I was listening, and I thought it was interesting. Sequencing might be the word of the year for 2023. That's my suspicion.
What we've got is to look at the Fed and the economy now, and we do that. We slow down here for a moment with Rubeela Farooqi, who slices and dices domestic American dynamics for Carl Weinberg at High Frequency Economics. Their notes are absolutely brilliant and deep. And yet there is a headline, Rubeela, that just stops you dead in your tracks. Chairman Powell is not sufficiently restrictive yet. How far away from yet are we?
Thanks for having me. The Fed has made it very clear they're not done. They still need to move rates higher, and they need to keep them higher. So, from all indications, we're going to end up slightly above 5%. We are following the Fed's lead. We don't believe in fighting the Fed, and we think that that's exactly where we are going to end up. Is probably another 75 basis points from here after over 400 basis points this year. So 75 basis points, maybe even a percentage point, depending on what happens with inflation and in particular the labor market.
The hallmark of your work and Dr. Weinberg's work is to study crisis and calm down. Carl Weinberg is steeped in this, folks, back multiple decades. What I hear from you, Rubeela, is we're going to get out to whatever restrictive is, and we're going to continue. Talk to the people now who are scared stiff of this path of higher interest rates. How do we survive it? How do we move on like that as Carl Weinberg has moved on from 7 other global financial crises?
But if you look at what the U.S. economy, how it has performed, how wrong we were about inflation, how wrong we were about the Fed, and how wrong we were about the economy and the resilience of the consumer, really we should be humble about what we think what 2023 is going to bring. Our baseline is that the U.S. economy will avoid recession. We're going to go into a very sort of below potential growth rate scenario, but there is enough momentum, there is enough support for households that the U.S. economy is going to avoid recession in 2023. Again, as I said, we need to be humble. Right now, the labor market is very tight. The Fed is not going to back off in its inflation fight because inflation is just way above where it needs to be. So this is the scenario. We've seen the economy perform. We've seen the economy do okay. We expect to slow down. But I think there is enough momentum in the labor market, in underlying strength in U.S. households that's going to keep this economy growing over the next year.
Where is the humility right now in the 4.8% terminal rate that's baked into market expectations versus the 5.5% expectation that you're talking about, and a whole host of other strategists coming out and saying the exact same thing that you are? Look at the economy, look at consumer confidence, look at sales. Everything is still going very strong, too strong for the Fed.
Well, I think from the market's perspective, it probably has to do with the fact that the Fed, the lagged cumulative effects of policy, right? I mean, we've been waiting for this economy to respond to rate increases. It hasn't happened. The labor market certainly hasn't responded. It is going to happen. We expect a pretty substantial step down in the first half of the year. And I think that's probably what the markets are pricing in. And then also there's the belief that the Fed is going to blink, right? This Fed is not the pre-pandemic Fed that was looking at a long period of low inflation. This Fed is very resolute. They have made it very clear. So I think there's a disconnect between what the markets are thinking and where we're actually going to end up. But I think markets are probably expecting the Fed to sort of back off once the economy starts to slow.
Can the Fed reach its goal if the market does not cooperate, if we don't see a tightening in financial conditions?
I think that's a great question. I mean, that's where, how does the disconnect get resolved? And we really don't have a good answer to that. If you look at financial conditions, if you look at what's going to happen, what's already happened with, lending standards, what's happening with rates on auto loans and what's happening with rates on credit cards. Financial conditions for households have already tightened. Now, and you've seen the equity market, it's not as weak as it was, but I think the Fed is looking at a broad array of conditions. I'm not really sure how this disconnect is going to get resolved, but, we need to be clear, the Fed is not, this is not a Fed that's going to back off, what they intend to do, which is to bring inflation back to 2%.
Rubila, what does trade dynamic do? I mentioned this yesterday, folks. There's a domestic side of the core GDP function, and off the back end, there's exports, good stuff going out of the country versus all the stuff coming in, including petroleum. What does exports minus imports do next year, Rubila? Is that something germane that we need to study?
Well, I think first of all, we need to understand that trade is not as impactful on the U.S. economy as it is on, let's say, European partners. But, what we have seen, what we saw this year was imports were just so strong. And then we went into sort of, a huge push from net exports in the third quarter. We think that this is going to start normalizing. We think goods demand, especially as, imports are going to start normalizing. Right. And then exports, that's where the uncertainty lies. I mean, if our trading partners are as weak as we expect them to be, then we're going to see that drag from, the trade part of the equation. But I think that the impact is going to be a little more subdued compared to what we've seen, the huge swings that we saw this year in 2022. I think that's probably going to dissipate in 2023. Again, it's a difficult call to make, especially if China comes back online. But this is what our baseline is for now.
Rubila, thank you so much. Rubila Faruqi with Carl Weinberg at High Frequency Economics this morning. Surveillance apology, and I'm also getting heat. I'm getting massive shade when I say Bitcoin BitDog. Okay, that's not a scandal, but that's like what it is. And then I mentioned lightly, and sometimes I misspoke, and I apologize for those that I offended about CarDog. Except I had no idea. I'm so ignorant on this, folks, and I need to apologize that there is CarMax and Carvana. One's out of Richmond, Virginia. One's out of Tempe, Arizona. But to your good wisdom, you smarter on this than me, Lisa, they both, I think I can use the phrase cratered without offending anybody. Well, I mean, it's a statement on the used car business, right?
There's a whole host of issues here. Okay, CarMax shares year to date down 54%. Carvana shares down 98%. That is a whole story unto itself, a question about the sustainability of an online used car sales dealership at a time when everyone is becoming a tech company and going online, and you're seeing that with other dealerships as well. CarMax is more of a clean read on the state of the used car market, how much you end up with a situation that you see a continuing devaluation of some of these prices. This, to me, is the fullest read on how difficult it's getting for people who have to use credit to buy big items, how difficult it's getting. If you're talking about an 11% interest rate to finance a used car, which prices have surged tremendously over the past 2 years, it becomes punitive, it becomes impossible, and that's why you're seeing demand decline pretty significantly.
These are high revenue companies. I mean, I folks, this happens. Every once in a while, I'm like wicked ignorant. That's where I am on this. I mean, and they dominate this business of I can never afford a new car. It's out of reach. And this is the digital combination of the 4 gazillion used car lots that we've all been on. And you can't afford the financing.
Well, they can't afford the financing. You also have a glut of cars because there had been a lot of fleets from rental companies that they were now selling. And so the prices went down quite a bit. This is really important, though, for overall inflation metrics because the disinflation that we're seeing, the deflation in used cars.
How does a girl that takes a crosstown bus know so much about this?
Things happen. One thing led to another. I think this
me.
is fascinating. This is such an interesting pocket of the inflation story.
The Bramo's on fire today, folks.
Something like that.
Carvana, forever. Stay with us. This is Bloomberg. Good morning.
The pivot will come next year, but not until risk assets have given up a little bit of the gains.
We think there is a recession both in the US and in Europe.
Every central bank is doing quantitative tightening next year. They're hiking pretty aggressively. We've really never seen this environment before.
They're going to stick to the course, and therefore we have risk of more serious recession.
By the traditional frameworks of how you would call a recession, we're just not there.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Stumbling to the end of the year with car talk and concerns about disinflation. Welcome back. This is Bloomberg Surveillance. I'm Lisa Abramowicz, Tom Keene, Jonathan Ferro off evidently on a bus. Where is he now right now?
He's just left Heathrow. He's sort of south of Bath, as they say. They say Bath.
Okay, well, I'm sure he'll be
he's
very
on his
great.
way to Exeter and Cornwall. There's like palm trees. I guess that's where he's going. He said to his family, "We're going south."
Well, they're not driving themselves, and
no,
perhaps in the U.S., if you are driving and it is getting more expensive to borrow money, but it is getting cheaper, evidently, to buy a used car. And that is a terrible thing for some companies that have seen a huge inflation on the bubble that you've seen in prices up till now.
This is the anecdotal that's so important as we stagger into the new year. And it happens, Lisa, with your reporting on Nike and FedEx. Yesterday, FedEx, massive logistical litmus paper. But, we're sort of very new car, used car here today. And what's great about this is we got listeners in Manchester. A guy sends in, he's got a photo of Manchester United jersey. Joel says they call him Ford Old Trafford, which has something to do with a stadium in Manchester, England. They called him up to buy back his new car that he owned or he bought like a year ago or something.
For more money.
I've never heard of that.
I know. This is
I've
something,
never heard of that.
But it speaks to the bubble in prices. And it's deflating. And this is one massive component. It's something like 10% if you put used and new cars together in terms of the component
Which is a big
factor
part of our budget.
for the CPI, for what the Fed looks at for consumer price inflation. Suddenly the bubble is burst, right? And you are seeing some sort of disinflation because people can't afford it. They can't afford it. Well, financing, they can't afford the prices after how much they've climbed.
You're going to do the data. We're going to go to Lee Farage here. But the bottom line to me is inflation dynamics and frankly the rest of what we do every day now is great a mystery as it was 12 years ago when we were very transitory. I think it is.
It's inconsistent. And I'll give you the other side of the story, which is the new car story. And this speaks to the many Americas, the many residents around the world that have very different fortunes. Used car prices are still rising. And that is because people can buy them and they can buy them in cash. You are seeing this with home prices yesterday coming out higher than people expected, increasing even as sales plummet, people buying in cash. It's the haves and the have-nots. Put that together, what kind of inflation picture do you get?
We don't know. And the answer to me, it's complex, yet others go to the aggregate. What I do is listen to the great David Rosenberg, who I think slices and dices like no one. And he says, look, we're in a disinflationary trend. That's what Rosenberg is.
And that's what we've seen in yields. If you take a look at what's going on in markets today, there's a little bit of a decline in two-year yields, despite some of the increase that we've seen in consumer confidence. Again, I'm trying to pair this, Tom, with all of the discussion we hear about how the Fed is going to have to curtail the optimism, the dynamism, the momentum in the U.S. consumer.
Do we agree that's a consensus right now?
That seems to be an increasing consensus. Two-year yields lower, 4.2% after being substantially higher earlier this year.
As Peter Hooper said with Deutsche Bank, Lazzetti's got a 5.1% terminal rate, and we're all going to die.
Yeah, exactly.
That's the theme.
Exactly. And you're seeing 0.2 of a decline on the S&P, but really it's been resilience heading into year-end, especially in the face of a lot of negativity. 3,897. Crude higher, a bit higher for consecutive sessions now. 1.4% increase on WTI, $79.37 a barrel.
China opening?
China opening.
Even with the heartbreak of COVID we covered an hour ago?
Where is that story in this crude price? That is my question. Do we see the reopening of China in that crude price, or is this just basically people shrugging it off because you're not seeing the real increase in economic volume yet?
You know, an 80 print on West Texas Intermediate, a lot of people, Jeff Curry, Francisco Blanche, and others, push against Ed Morrison. They say we go back to 100. I guess they're opening. Bloomberg News reporting this morning, folks, of quarantine lift in China. Q+3, I think, is the new phrase. I'm not sure on that, but, you know, there it is, and that's how you get oil up.
Meanwhile, we are looking at this disconnect with what the market is seeing with respect to rates and what the Fed keeps saying. Lee Farage is joining right now, head of macro strategy for North America at State Street Global Markets. I want to start there, Lee. Why is the market not listening to what the Fed is selling?
It's a very good question. I'm not entirely sure. I think it goes back to what you've been discussing. You know, we have got these pockets of weakness. We have these areas, you know, some people believe we're in a disinflationary trend, and to some degree we are. So the assumption is, well, the Fed's being too hawkish. They're not going to deliver on what they're saying. And so the market is basically ignoring them. I mean, and don't forget, you know, the last Fed meeting last week, there wasn't much left of the trading year. You know, it's been very quiet this week. I do believe in January, though, the market's going to have to get closer to where the Fed is. I mean, we have a terminal in the market of 485. The Fed's at 5 1/8. You look at the end of 2023, there's a 75 basis point gap between what the market has and what the Fed has, and that's got to close.
How violently could it close? This is really the issue that I see heading into year end, given how much is hinging on this rate and how wildly different these estimates are.
Yeah, I think, you know, once we get into the new year, I think it could close quite sharply. And, you know, this is why I think it's going to be a rough start to 2023 for risk generally in asset markets, because we have to get some sort of, you know, move in the market towards where the Fed is. You look at the data, yet there are pockets of weakness without a doubt. But look at that consumer confidence number yesterday. Expectations, 82.4 were the highest since January. So the consumer looks forward in the economy and is most confident he has been, or that they have been, since January. And that is a problem for the Fed when they want to curb excess demand.
Can they do that? Do they have the tools? Lee, John Golub at Credit Suisse agrees with you strongly on this as well. There seems to be a belief a central bank can, quote unquote, curb excess demand. Is there proof of that?
Well, they can do it, but can they do it without causing the recession is the bigger question. I mean, they can do it. The problem is in the US, because we have such a high degree of fixed rate borrowing, the only real way the Fed can curb excess demand in the US is through higher unemployment. And you mentioned that the used car market is interesting. Yes, new activity in the car market, the used car market has plummeted because loans now are, you know, at a significantly higher rate. If you look at, you know, the housing market, new activity has plummeted. But if you have your house and you have your mortgage, if you have a car on a fixed rate loan, your monthly payments have not changed even as the Fed is raising rates. So what's that done to your aggregate demand? It's not changed it. Whereas if you look at other countries, you look at the UK, 90% of mortgages are floating.
That's right where I wanted to go. And, you know, John Farrell, folks, you know, we bust his chops on this, but this is a huge UK distinction, a floating rate paper. Does that change the script for Governor Bailey and President Lagarde versus the fixed rate world of Jerome Powell?
Absolutely, it does, yes. If you look at market pricing, the terminal rate for the Bank of England is only 20 basis points below the Fed's terminal pricing. That makes no sense. When you have the consumer in the UK is suffering significantly. You look at the GDP numbers we had this morning. So, you know, personal consumption was down 1.1% in the quarter. That's the weakest since Q1 2021. But Q1 2021, the country in the UK was locked down. Nobody could spend anyway. So you're seeing the consumer really start to suffer because their mortgage payments are going up. Your real earnings squeeze is greater there as well. Whereas here, as I say, if you have your house, you're not going to move. So, you know, new transactions will plummet, but your mortgage payment has not changed. 90% of US mortgages are fixed for 30 years. That is a big problem with the Fed when it comes to wanting to curb excess demand, a problem not faced by others.
So from this tangible reality of housing to the macro, how this factors into what your call is for next year, does this mean more dollar strength? Because there is this greater resilience to higher rates when it comes to housing, when it comes to cars, than, say, in the United Kingdom or even broader continental Europe.
Absolutely, Lisa. Yes, that's exactly what it means. We're going to start to see divergence in the first sort of quarter, the first half of next year. The Fed is going to have to keep going because of this fixed rate environment we're in. Whereas you look at, the Bank of England going to fall by the wayside. We're seeing the Bank of Canada get towards the end. The RBA, huge amount of variable rate mortgages in Australia. The RBA are getting close to the end, maybe at the end. But the Fed has got more work to do. So that's going to be the thing that drives the dollar higher again in the first quarter. And I think probably the first half of next year, you're going to see the dollar sort of rally further and bounce back because you're going to get this divergence in policy.
Lee Farage, thank you so much. Greatly appreciated this morning with State Street Global Markets as well. I want to dovetail on the horrific weather we're seeing. It gets ice cold in New York City, days behind the rest of you across this nation. Good morning. On Bloomberg Radio. And Lisa, we've got some important imagery from our trip to Jackson Hole where you and I and John was really freezing. It was ugly. And it's like literally 42 degrees or 38 degrees in August there. And Adam Posen shows up in a short sleeve shirt from the Peterson Institute to talk a 3% inflation level.
Yeah.
Negative 26 this morning.
Okay.
On that same deck.
So just to be clear, this isn't live. This is a screenshot of a live frame from that moment that we look to be floating in a very cold space. And there is this question of the 3% inflation. There's also a question about the weather and why Adam Posen did not bring a jacket, but we'll get into that another time. Right. This is going to be one of the issues. Is there a stealth allowance of 3% inflation by the Fed next year?
This is to review this, and folks, this is the academic debate led by Olivier Blanchard, a colleague with Adam Posen at the Peterson Institute, off of research at West Virginia Commonwealth, Virginia Commonwealth, VCU. And the bottom line is where does inflation mentally change our behavior? That's the heart of the discussion. And Blanchard, off that research, is suggesting racing back to 2%, or as Bill Dudley says, below 2%. Maybe doesn't change our behavior. We need some inflation higher to change our behavior.
The problem with this is if the Fed acknowledges out loud that their target is now 3%, get ready for 4% inflation to become the norm, right? That people will basically think that they aren't going to necessarily have the credibility to fight some of the inflation.
One of our interns this morning got that from the assistant director. It's amazing.
One of our staff.
From Georgetown, I think.
Yeah.
Oh, good morning, Georgetown.
40 people.
Futures at -9. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Kremlin criticized the outcome of Ukrainian President Volodymyr Zelensky's visit to Washington and warned that Russia would continue to target weaponry supplied to Ukraine by the U.S. and its allies. A Kremlin spokesman says Moscow followed Zelensky's meeting with President Joe Biden and speech to the U.S. Congress and saw no sign of a willingness to listen to Russia's concerns. Meanwhile, President Vladimir Putin says that Russia has no limitations on military spending for the war in Ukraine. U.S. authorities allege fallen crypto titan Sam Bankman-Fried defrauded investors in his FTX empire, stealing billions of dollars over years for his own benefit. Now, top Bankman-Fried associates Carolyn Ellison, former CEO of Alameda Research, and Gary Wang, co-founder of FTX, are accused of helping him. They've pleaded guilty to federal criminal fraud charges and are cooperating with prosecutors. The U.S. Securities and Exchange Commission and Commodity Futures Trading Commission also announced separate lawsuits. Bloomberg has learned China plans to cut quarantine requirements for overseas travelers in January. Under the new rules, the requirement to spend time in a quarantine hotel or isolation facility would be scrapped, and arrivals into the country instead subject to 3 days of monitoring. Overseas arrivals currently isolate for as many as 8 days. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Bloomberg Surveillance. Good morning, everyone. Jonathan Ferro on assignment. Lisa Abramowicz and Tom Keene with you on a Thursday. Coming up 15 minutes, I'll say, claims. That's an important distinction. Also, I believe a third or fifth look at GDP will do that. Coming up as well, Henrietta Trays on when politicians in Washington will leave for the mother country. There's still much at work, as Mr. Schumer out with headlines here, and we'll get to you in a moment with Henrietta Trays. We're making light of it. It is not funny. There is brutal cold across this nation, the kind of cold that kills livestock and causes real risk to people. We don't mean to make light of it. And one of the things as well, maybe for my youth, Lisa, because so much of citrus production is moved to Brazil, moved offshore, but nevertheless, we're on the citrus watch in Florida.
You and I have been Googling where
we're learning
the weather of Florida orange production. I'm looking right now. Daytona Beach actually has a pretty big orange grove. The weather gets down to 27 degrees tomorrow. It gets down to 28 degrees on Saturday. Tallahassee, Florida goes down to 18. We're looking at temperatures of 12 degrees in Dallas, Texas. This is unusual weather for areas that have relied on warmth and raises some questions about infrastructure, heating costs, as well as crops that already have seen elevated pricing.
Yeah, and I go again, and to bring this over to Europe, where there was a warmer autumn, I'll call it, and it just seems to be drifting away. Can you imagine this cold across Mr. Zelensky's Ukraine and, frankly, the adjacent nations?
I hope
it's just
that
unimaginable.
It's unimaginable, and I hope that everybody stays safe during the holiday season, because it's going to be ugly. There's going to be wind. There's going to be ice. I was looking at the conditions.
A looser broadcast of Bloomberg Surveillance than normal, because economics in the markets are pretty quiescent right now. I would suggest that the Bloomberg Financial Conditions Index shows accommodation out there, as we saw with a smart equity market yesterday. The VIX 20.23, signaling that good news in equities yesterday. Futures -10, Dow futures at -58. Right now we continue on Washington, but digress from where Anne Marie Horton was on this historic moment yesterday, and we look forward to the domestic ugly politics of which Henrietta Trays is truly expert. She's director of policy research at Veda Partners. Henrietta, Senator Schumer out with headlines here off the morning shows, and they've got to get business done. What actually happens in those rooms on December 22, 23? What is the horse trading that actually goes on?
Yeah, absolutely. Great question. They're working with the parliamentarian right now and trying to coordinate with Senator Mike Lee, a Republican out of Utah, to get an agreement on something called Title 42, which is a controversial immigration component that President Trump put into effect back during the height of the COVID crisis, and which expires. So they're trying to horse trade a vote on that amendment in exchange for passage of a $1.7 trillion omnibus spending bill. And every senator and every House member wants that in their stocking this year. I expect they'll get it, but these fights take until the bitter end. I'm hoping that votes will start at around 30.
So to the imagery that we see in the South, and I will state, folks, I'm as guilty of this as anyone, removed from my life. But the imagery that we're seeing down South has shocked Washington and, frankly, shocked the nation of all political persuasions. How does that story change once this agreement is made? What is the new immigration policy, dare I say, of December 27th?
That's a great question. I mean, honestly, speaking with staff on both sides of the aisle, Democrats and Republicans, there are a handful of bills out there, and all of the business community and every economist is looking at the labor shortage and saying we need everything from seasonal workers to high-skilled workers. And there are bills out there to accomplish all of those things while simultaneously addressing the border. But we are too far into, unfortunately, the 2024 presidential election cycle to even get close to having an immigration bill passed in the next 3 days, let alone the next 2 years. So quite frankly, I don't think there's going to be a material change at the border. I imagine they'll find some sort of convenient off-ramp to get around Senator Lee's amendment, but it probably will not change a whole lot. And I'm not anticipating anything material to come out of reform, either at the executive level or via legislation on immigration before this year is out. And then again, as I mentioned, probably not for the next 2 years either.
Henrietta, after the midterm elections, people were talking about a move to the center, that there would be more of a collaborative kind of feel, more of a rejection of the truly hyper-partisanship of Washington, D.C. over the past decade or two or three. How much does that actually fly in the face of what's actually happening as we count down to a deadline and are getting gridlock?
I mean, right now we're going to get a bipartisan deal on the surface, but you're going to see this bill pass with almost exclusively Democratic support in the House and hopefully something in the range of about 70 votes in the Senate. So the Senate will be bipartisan. The House will not be. And, you know, if you want to tie it into the speech yesterday from President Zelensky, it is notable that there were only 85 Republican members of the House there. There are 213 of them at least. That incredible event, coupled with partisanship at its most extreme, I think was really well illustrated. And that's what next year is going to look like as well. They're trying to tie in Department of Homeland Security funding. There are going to be impeachment trials. I'm not expecting any legislation will pass. It's remotely material until we get to the Farm Bill, which will have material implications for SNAP benefits, and then the debt ceiling, which we'll have to deal with around September, and will probably be a very ugly fight. And the reason we're getting this omnibus now is so Kevin McCarthy can wait to deal with the debt ceiling until September instead of having to fight that fight right out of the gate in 2023.
I'm glad you mentioned the debt ceiling debate. It has particular poignancy as you see borrowing costs rise to the degree that they have. How much do you think that will actually get a growing number of Congress members on board to reduce the deficit, to really pull back on some of the issuance?
None. There's no way you're going to see any fiscal austerity actually come to pass. There will be no spending cuts. There will be a lot of jawboning about it. They'll talk about it extensively. I imagine there will be headline risk and we'll probably get down to the wire. But when you talk with staff, it's pretty clear they already know the path forward. And it's not even going to be via finding a new number to replace the $31.4 trillion in debt ceiling authority Treasury currently has. We already know it's going to be a suspension, which was a Boehner era development that would suspend the debt ceiling, give Treasury a blank check to operate through X date, because it's a lot easier to vote for a date than it is to vote for a $32 trillion debt ceiling. And they don't want those optics. So I'm not expecting any austerity from this.
Henrietta, you said the presidential race has already started for 2 years from now. You're a grizzled veteran at this. When do we hear from President Biden? When do we hear from President Trump? And when do we hear from another 10 worthies? Is that really what January awaits?
I think so. My latest conversations with administration staff were suggesting that right after the holidays, President Biden is geared up and ready to announce. That's contrary to what my original expectation was. I thought former President Trump would not announce, and that President Biden would therefore also not announce. But the incredible showing that Democrats had in the midterm elections has materially changed that trajectory. And from everything I see, Democrats and President Biden in particular are geared up to launch right after we get back from the holidays.
Henrietta, thank you so much. Henrietta Trey's Veda Partners here as Congress staggers, is typical, I should say, to a year-end closes. So what are you looking at, Lisa? You're over there typing away. You're pounding things. What do you got going?
Just
help me.
Smashing on my keyboard like nobody else.
Future's negative 12.
What I was actually thinking about was what she just said, this question of the jawboning about bringing down the deficit, but no action would be taken and that they were going to continue to spend freely. How that's going to play into this belief that there would be a change, a shift, a lack of a fiscal response is interesting to me. I don't think that that's something that's talked about as much as perhaps it should. Other than that, the market's pretty quiet. People are settling in. It feels like the first day ahead of the holiday after what had been a really busy week.
Well, yeah. I mean, okay. First of all, we got blindsided by the Bank of Japan. I mean, am I right? No one saw that coming? I think that's a safe phrase.
Yeah, there were some tea leaves about a week earlier that perhaps they were open to some changes, but it took the market definitely by surprise.
Are we going to be surprised by claims here in 4 minutes? Make it 4
minutes? I think we have to wait and see. Stay with us because we're going to be looking at claims. I don't know.
Michael McKee, he's on a bus to Cornwall as well. Michael McKee looking at continuing claims. This is Bloomberg. Stay with us. Bloomberg Surveillance, we welcome all of you here to Economic Data. Yes, Economic Data today, and coming out here on claims and such. We'll have that for you here in a moment. Claims is important. That is a weekly data. The 4-week moving average is something on the Bloomberg as well. But critically, there is continuing claims. Michael McKee with John on a bus to Cornwall says I should really focus on continuing claims. Lisa, these are much bigger numbers. Initial jobless claims, let's call it 220. We'll get the number here in a moment. There's a number. Right 216, a more constructive number on claims. Don't have the 4-week moving average in front of me. But continuing claims still steady there, and maybe to watch in the weekly data to come. And then there's the third blush of GDP.
Can I just point out that the market really moved on this data, on the initial jobless claims, and perhaps it's just a nudgy Thursday ahead of the break, but if you pull up the 2-year yield, you see that pop,
boom,
real boom, and you can tell that people are concerned about the tightness in a labor market that seems to be confirmed by this.
Yes.
How many downside surprises can we get? It is a strength, it is a resilience in a labor market, people not filing for jobless claims. That belies this point that people are looking at for some sort of downturn.
I've got a shock number as well, and that is GDP. This is really important. The third look at third quarter GDP ending September 30 is not 2.9%, and this is demonstrably more buoyant, 3.2% with personal consumption, a big lift. And what I do, Lisa, is I take 3.2% and I add it to the GDP price index, and I've got a nominal GDP of 7.6%, which is that buoyancy that John Golub, among others, was talking about.
And core PCE coming in revised upward to 4.7 from 4.6%. Again, all of this speaks to this strength, this willingness for consumers to keep spending, even though people are expecting a recession. If it's going to happen, where is it?
Well, there it is. And, of course, we've got curve inversion moving. It's a 2 basis points, not all that much, but negative 57 basis points. And we have the perfect guest to speak of this as well as futures roll over, futures in negative 20, Dow futures negative 122, and the VIX comes out immediately to 20.39. Suddenly, it is an interesting Thursday. It has been an interesting 2022 for Andrew Hollenhorst and Veronica Clark, economists at Citigroup. They were way out front on a terminal rate above 5%. I give them credit with Anna Wong of Bloomberg Economics as well, and they reaffirmed that this morning. Veronica Clark, I don't know if you've seen this data. We've been chatting about it, but to be very direct, this data confirms the Hollenhorst rate, doesn't it?
Yeah, it's a bit interesting to see markets move on a third release of GDP. You know, we've gotten this data a couple times already. These are revisions, but they were pretty big revisions.
Yes.
Both headline growth number, stronger consumption. You know, that's all where you want to see the strength and activity is consumption and investment. And then I think especially that core PCE number revised higher. You know, markets are really hoping to see softer inflation now, and we're really not getting it yet.
What is your interpretation where the chairman desperately needs a lousy labor market? He's not getting it. But what is the study that you have of the disinflation path forward? Do you see a greater disinflation, everything considered?
Yeah, I mean, I think we will get some overall softer inflation prints in 2023. But it will be because of things like goods prices that are much weaker. We know that shelter prices and inflation measures should be softening with, housing market that's already softer. But yeah, you really do need to see a loosening in the labor market to be convinced that third component, that non-shelter services, will come back down to 2%, because we really don't see a path for that to happen until the labor market loosens.
And we were talking about this with Lee Farage. There's a real disconnect here between your outlook for what's going to happen, between his outlook for what's going to happen, between the Fed's outlook with what's going to happen next year, and what the market is saying. And I'm almost surprised that the market didn't respond more, albeit this is the third read of a GDP for third quarter, and this is also initial jobless claims. But still, the evidence keeps coming in that you are seeing strength, you are seeing resilience, and that the Fed will make good on what they're saying. What will it take to trigger a reset in terms of market expectations?
focused on the last two CPI reports, right? Like we've had, two softer reports. If you just listen to the CPI data in 2022, it would tell you that the Fed was going to be more hawkish than they thought, than what most economists were thinking. So maybe that's the right move now. But I would really caution against that because, we could get into 2023 and, we'd still have some upside risk, even to things like used car prices, which wholesale measures are rising again there. And you do have a lot of upside risk to those non-shelter services. If you look at where wage growth has been, it's telling you that those prices should be higher still.
I'm glad you mentioned used cars. We've been talking about it all morning because CarMax came out with their earnings report well below what people were expecting. You're seeing those shares plunge. It's also raising concerns about its peer Carvana and other used car dealerships, and just generally this idea, this is where you're getting the disinflation. Prices for used cars that were sky high, where some people were saying were a bubble, are disinflating, are deflating. How much further does that have to go? Is that a 2022 story, or will that deflation continue next year?
Yeah, this is a really tricky component because, it's not necessarily telling us, much about underlying inflation trends. This was the supply-driven type of inflation that we had as early as 2021. And we have had, pretty big declines for the last two CPI reports. That's been a big reason why we've, run below, 0.4s or, that we were running. I mean, you see some of that, I think, again in December. But the best measures we have of where used car prices are going are some of these wholesale measures. We got data earlier this week from the Manheim Index that showed those actually are starting to increase again. So it's not a clear downward trend as we're getting into 2023. I think the issue there is, inventories of cars are just still very short, and that's keeping dealers from cutting prices too dramatically.
Veronica, if we get a Hollenhorst rate, there's just this belief out there the world ends as we know it. Now, I know Citigroup Economics doesn't believe that, but what does our world look like with a 5% plus terminal rate? I think into the outlooks of next year, there's a huge mystery to that.
Yeah, I mean, I think our rate of 525 to 550, is not necessarily the most dire situation. We do have the unemployment rate rising. That is enough of it's a high enough rate to cause a mild recession. But we're not talking, 7-8% unemployment. We've got it getting to a bit above.
Wait. Do you see evidence of a labor market troubled? I don't see the evidence other than the flash of tech and maybe the flash of every financial institution except Citigroup. I just don't see the evidence.
No, we wouldn't yet either. But I think, if you start with the assumption that the Fed will do what it takes to control inflation, and in our view, that's getting rates at least to 525 to 550, potential upside still. That means that they need to see a loosening in the labor market. And we're not seeing it yet, for sure. But as we're getting into the middle of next year, we would expect that you're seeing starting to rise in the unemployment rate.
Veronica, stay with us. Radio and television, good morning to you. An economic set of data at 8:30 here that moved the markets. No question about that. Yes, it's a Thursday before the holiday. Yes, it's boring. No, it's not. Futures deteriorate, -20 Dow futures. Less or so, I'm going to call it, down 121. NASDAQ down 0.7%. Excuse me there. 20.36 on the VIX. And Lisa, you earmarked now out 3 basis points, the 2-year yield, higher yield, 4.24%. I guess it's a Jerome Powell, he is going to raise rates feel.
It's a feel that perhaps we can't be complacent in this bet that we're just going to continue with a disinflationary impulse. And Veronica, when we start going into the granularity underneath it, it becomes very interesting because we can see that some of the disinflation in goods changes course next year. Are there other areas like that where some of the aspects of the inflation read that have brought down inflation this year will reverse and go the other way next year? I think about oil prices, gasoline costs. I think about what you're talking about with used cars. Are there other components as well to cause more goods inflation next year than people are currently accounting for?
Yeah, I think there definitely are still some underappreciated, maybe upside risk to goods prices. I think most people expect that, supply chains have, been correcting. Goods demand is much softer. Yes, commodity prices are lower too. And that means, softer core goods prices. But there are some upside risks, if we're, getting into a cold winter, higher energy costs, China reopening, if there's, a lot of people who are falling ill and not being able to work, and that creates new supply issues, that there's definitely some upside risk to goods broadly, not just cars.
Veronica, thank you so much. Greatly appreciate it. Veronica Clark with us at Citigroup as we have moving markets here off buoyant GDP as well. I guess it's claims in, a fully employed America, Lisa, that gets it going. But I'm sorry, a 3.2% statistic on GDP is stunning, ending September 30.
And what's it driven by? Personal consumption up 2.3% versus the initial read of 1.7%. But this isn't just an initial read. This is the third revisiting of the data. It kind of speaks to what we're talking about, how complicated it is right now to get a clean read on what's going on, given all of the different inputs that are moving at different paces.
Tom Purcell publishes moments ago with RBC Capital Markets along that line. The consumer, how resilient. And I think we heard today that surprise from Peter Hooper at Deutsche Bank, from John Golub in strategy at Credit Suisse. That's the surprise here into the season. And with what I have to cook for Christmas dinner, I'll be adding to the consumption.
Oh, yeah? I thought you were doing the ham.
I think I've got to make like 3 stops at 4 grocery stores or something, Can you imagine what the lines are going to be like at the grocery store?
I guess you're going to find out. You'll do some frontline reporting.
Do you read the magazines when you're in line and put them back? Do you do that?
I haven't done that since I was about 15.
Okay, well,
so no,
that's how I get briefed
don't.
on the market.
Yeah, exactly. No, look, this is going to be an interesting holiday moment because people still have jobs, and the sentiment read that we just got that was higher than expected speaks to that. People are levering up, yes, but they're also getting wage gains. How do you parse this into the consensus maybe a month ago that we're going to have a recession next year at the beginning?
I'm looking at 7% plus nominal GDP. I'll defer to the experts. 3.2% GDP against all that gloom of last summer as well. And I go back, and dare I say it is not 2 Americas, it's 3 Americas. There's an America that all the politicians, everyone has to decide is a lost America. It's always been there. I think it's grown as my op-ed for the day. But then there's an America dealing with their recession, dealing with their inflation in spades without wage growth.
I will say that probably the quote of the morning comes from Bespoke Investment Group is market participants try to parse through all of these vagaries, make a game plan and stick to it. Unless it's not working, Yogi Berra. Coming up, we're going to discuss that. We're going to discuss the multi-tiered aspects.
Steve Cohen's efforting Mr.
Exactly.
Berra for next season.
Peter Scheer of Academy Securities and Mike Katopoulos of Richard Bernstein Advisors. As I take off, I'm going to leave, and we'll be together.
Are you leaving
tomorrow.
now?
I'm going to leave, yeah. I'm going to take off.
We have a staff of 28, and nobody tells me you're leaving?
Here, I'm going to brief you right now. I'm taking off.
Well,
I'll see you tomorrow.
Good.
Have a wonderful afternoon.
Yeah. I have to be here tomorrow?
You do.
Oh, okay.
We'll brief you on that, too. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. UK household incomes fell for a 4th straight quarter, leaving Britons on course for the worst period for living standards in memory. Adjusted for inflation, disposable income per person declined 0.5% in the 3rd quarter, according to the Office for National Statistics. Gross domestic product also fell. Economists say the cost of living squeeze has likely already pushed the UK into a lengthy recession that may last until the end of next year. A new analysis shows China is likely experiencing 1 million COVID infections and 5,000 virus deaths every day. That's according to Airfinity, a London-based research firm that focuses on predictive health analytics. Now, COVID is making its way virtually unchecked through China. Hospitals are overwhelmed, and patients and crematoriums are being pushed well beyond their capacity. And JPMorgan Chase is upping its climate ambitions. The firm is announcing a slew of new emissions reductions targets for its financing to carbon-intensive businesses, including airlines and cement manufacturers. The largest U.S. bank said in this year's climate report published today that it plans to reduce the carbon intensity of its aviation financing portfolio by 36% by 2030. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
By the traditional frameworks of how you would, call a recession, we're just not there. There's room, I think, for the Fed to step down because the inflation data probably gets better over the next couple of months.
Neil Dutta, he has been optimistic, and he just got it in a third quarter GDP report. Granted, a look back to September 30 ending, but nevertheless, the consumer resilient has been a message on this Thursday, and it speaks to the pushing away from recession fears that Mr. Dutt has provided leadership on. We'd also note Peter Hooper at Deutsche Bank, who had a recession call, but said everybody's wrong about tomorrow. It's out there somewhere. We're going to finish the hour strong here with the markets moving. Futures -15 are now -30. A real deterioration in futures, 0.8%. A stick on the NASDAQ 100 down a full 1 percentage point. VIX is going to get a 21 print here pretty soon. And this deterioration is off buoyant claims, a good number, a fully employed America, and a stunning 3.2% Q3 GDP. All of that makes for a good economy. And Anthony Dwyer at Canaccord Genuity is someone who has steadfastly been bullish, waiting for recession. Well, the recession is here, as many opine. And Mr. Dwyer has finally changed his view from being the resilient optimist to moving forward with caution. Define the level of caution, Tony Dwyer, as we slip into 2023.
Well, first time, thank you for having me and happy holidays. We turned cautious early this year, so it's not a new call for us. And ultimately, it comes down to when the Fed and when Jerome Powell invoked his inner Volcker, where he said in early June that he was referring to how Paul Volcker inverted the yield curve, raised rates to try and curtail economic activity that would, stabilize the inflation rate. Well, that happened when Volcker did it. You were in a generational low in debt to GDP. We're in a generational high. So if you're going to shut down a levered system to try and curtail inflation, you got to be careful you get what you wish for. So our call is when you've got the yield curves inverted like they are, the leading economic indicators acting as they are, and so many indicators would be historically unique to not go into recession.
Does inflation come down quicker? And if that is the case, how does it fold into your equity strategy?
So, Tom, for the better part of the last 12 years, as you know, I've been the permabull. People, they call me the permabull. And then early this year, when we took a more defensive posture because of the way that inflation was trending, it meant that the Fed was going to be having to do what they're doing into a levered system. And I just don't see how that is healthy. So I think at this point, folks are looking at maybe not the wrong data, but inflation isn't going to be the issue in 2023. Goods inflation, as was pointed out earlier by Lisa, is coming down aggressively. The problem is that labor inflation is defined by non-housing related services from Jerome Powell at the last press conference, which makes up 50% of core inflation. That is still rising. And that makes it more difficult for them to lower inflation while, to their desired level.
Tony, my mandate says I've got to own stocks. Where do I hide, given the Dwyer gloom?
So the hardest part about this is when you go, like I said, it would be historically unique to not go into recession given yield curves and other indicators. If that's true, it would be historically unique to have already made the low for the S&P 500 prior to the recession. So even though defensive-ish sectors are expensive, it's kind of a consensus call. That is typically what works as you enter a recession into the first part of it. When the market makes a low, which I think it will in the first half, I want to be in a position, our call isn't to go out and short everything and get super negative. That time was earlier this year when we made it. I want to attack the weakness as it happens, because the worse the economy is now, the better the market can be, because the Fed will be able to lower rates even before renewed expectations for the second half next year.
And energy is the darling this year. We saw energy, on Brent 110, 120 on down to Ed Morse of Citigroup's 80 call of the year by Ed Morse. And yet other people with China opening are modeling up. Does energy sustain? And if that's so, what kind of oil sector equities do you buy, Tony?
Well, you don't buy economically sensitive sectors right before a recession. So that if we don't have a recession, this is wrong. But again, energy fits in with that. Industrials, which has become everybody's new favorite. Hey, Tom, guess when industrials make their peak.
Please.
It's typically right before a recession. And it's always different this time. So again, the energy space has already come down a bit, but it is everybody's favorite are the cyclicals. And I just want, at this point, as we head toward a recession, I'd move more into the defensive areas.
My problem, Tony, with the layered gloom out there, and as you say, you're participating even with the caution, is you get shocks along the way. For example, the mother of all shocks earlier this week, the Bank of Japan, Tony Dwyer, folks, writing up his Bank of Japan paragraphs mentioning John Ferro. You didn't mention me. You didn't mention Bramo. You mentioned John Ferro. But those are the kind of shocks that lead to things unwind. Things become clearer, and I get a comfort to own stocks, right?
Maybe. This kind of volatility in the currency markets isn't healthy, whether it's perceived as good or bad on that minute. The issue is the European Central Bank, all the central banks are tightening. That restricts money. Tom, we love formulas. We love quant programs. We love to say smart words. You can't spend money you don't have. So the reason that the economy is doing well right now is earlier this year, we transitioned from, I called it buying stuff to doing stuff. When you reopen the global economy, people want to get out and do things. That money was allocated. That's what we have now. The issue going forward is where are you going to get new money? If the unemployment rate ticks up with the Fed tightening, if money growth starts to slow, as already historically slowing with real liquidity based on the Fed action, and banks are tightening their lending standards, where are you going to get the money for excess growth?
Look at the Washington data this morning, Tony, on 3.2% GDP, and there's like paragraph J, way down below. It says the Dwyer family single-handedly supported the needle on real GDP by their airfares. Helene Becker says...
every day, Christmas comes every day at the Dwyers. It's right on the front stoop, and it's brought by Amazon.
Well, it's there. It's bought by Amazon. I'm sorry, I don't observe things that badly. Can I participate in this consumer boom with the airline stocks, which are barely off their pandemic lows?
Again, it comes down to expectation in the recession call, Tom. Like I said, it would be historically unique going forward into next year for the economy not to go into recession. If that's true, the services are going to just think about that. We're 6 months into this. 4 months ago, people are screaming about how expensive used cars are. How expensive other goods are. Now there's semiconductors, you couldn't even come close to getting enough. And now there's a glut of all those things. We've got to be careful because in terms of human nature, it's all about money and human nature.
Okay, but then when did you get out front? Come on, you're too young, Tony, to remember 74, 75. There's a point where you have to slip into the market as you turn. You're expert at knowing that point to turn. Clearly you're saying don't turn now. But what will you look for to know when to get into equities in May, June, July, whatever?
It's a total, not the initial rate cut. That's typically actually a sell signal when you're going to go into a recession. But it's when the Fed is getting really aggressive about lowering interest rates, and they love to talk too much now. But back in the, you want to see them start to bring the dot plot well lower and acknowledge the economic weakness. But more importantly, Tom, this is human nature indicators, sentiment, oversold conditions, intermediate term oversold conditions, what we call as whooshes, typically show up when the Fed is really easing and the market's getting blasted anyway. And as I said, that should happen at some point in the first half. I know it's consensus, but sometimes consensus is right.
Tony, we got to go. It's wicked cold Saturday in this region. I want you to be careful on the Zamboni in the backyard with the ice rink. I know you got the John Deere thing going. Just really watch it, Tony, out there in the ice rink running the Dwyer Zamboni. Mr. Dwyer is with Canaccord Genuity. To be honest, I've never heard him, folks, that cautious. Caution in the market this morning after the big lift yesterday. We give it back. We do so off a buoyant third quarter GDP view. Big redo, 2.9% out to 3.2%. Claims just simply a fully employed America. Initial jobless claims, 216,000. Futures minus 15. They continue to deteriorate at this moment, negative 34. Please stay tuned to us on radio, on television. General Kimmett in the 12 o'clock hour with David Weston.